Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive right in. Today, we're cracking open the playbook of a true legend, Warren Buffett. And look, this isn't just about stocks and numbers. We're getting into the actual operating system, the mindset, the habits, and the core principles that built an absolute empire. And, maybe more surprisingly, a life of real wisdom. And this quote, it tells you everything you need to know about the guy, right? He's not just some stuffy billionaire. He's got this incredible, down-to-earth sense of humor. The man drinks, 5 Cokes a day? He's relatable. And that's what makes his wisdom feel so much more powerful, so much more possible for the rest of us. So let's get into it. First things first, before we even talk about a single dollar, we have to talk about what's going on up here. Because for Buffett, this is everything. It's the foundation. It's the part most people just skip right over, but it's where all the real wealth and, honestly, the real work actually begins. And this is the big one. This is what so many people get wrong. You do not need a 160 IQ to be a great investor. What you need, what Buffett says is absolutely critical, is temperament. It's about keeping your head when everyone else is losing theirs, not panicking during a crash, not getting greedy during a bubble. That emotional control, that is the real superpower. You know, his take on hard work is also just so simple, it's brilliant. It really comes down to just 2 things. First, he's basically quoting Woody Allen here. 80% of success is just showing up. Be there, be reliable, be consistent. That alone puts you way ahead of the game. And second, good old-fashioned perspiration. Just like Thomas Edison said, you gotta put in the work. Simple, right? But incredibly effective. And this is what it's all for. This is the end game. It's not about slaving away at something you can't stand. The goal is to find the thing you love so much that you literally tap dance to work. That genuine passion, that's the fuel that's kept him going for decades. That's the real source of his success and, you gotta believe, his happiness. Okay, so you've got the mindset dialed in. What's next? Well, now it's time for a little financial boot camp. We're talking about the absolute must-have fundamentals you need to get right before you can even think about building serious wealth. So let's start with the basics of the basics. You've got your savings account. Super simple, right? Your money's safe, you can get it whenever you want, but the interest you'll earn is gonna be pretty tiny. On the other hand, you have a certificate of deposit, a CD. Here, you'll almost always get a better interest rate, but there's a catch. You have to agree to leave your money in there for a specific amount of time. It's that classic trade-off. Do you want easy access or do you want a better return? Now, as you start to get your finances organized, you're going to run into these weird acronyms, right? Like a SWIFT code. Sounds super technical and intimidating. But all it is, think of it like an international zip code for a bank. It's just a standardized system that makes sure when you send money across borders, it actually gets to the right place. Understanding little things like this just demystifies the whole world of finance. Now, this number, 18%, there's an incredible story behind it. A friend of Buffett's once came to him and asked for a hot stock tip. You know what he told her? He pointed to her credit card bill and that 18% interest rate. He said, pay that off. That's the best investment you will ever make. And why? Because there is no stock, no fund, nothing on earth that can guarantee you an 18% return. But paying off that debt, that's a guaranteed 18% win. It's such a powerful way to think about it. And that story leads perfectly to this piece of advice. He is so blunt about this. Carrying a balance on a high-interest credit card is just financial self-destruction. It's like trying to fill a bucket with a giant hole in the bottom. You can pour all the money you want into investments, but that debt will drain you dry faster than anything else. All right, our financial house is in order. We've plugged the leaks, we've moved from playing defense to playing offense. Now we can get to the fun part, taking that money and making it grow. This is the core of the legendary Buffett investment philosophy. This right here is one of the most famous Buffettisms of all time, the economic moat. He thinks of a great business like a castle, and the profits of that castle need to be protected. The moat is whatever special, durable advantage that company has that keeps competitors at bay. It could be a brand name, a secret process, a low-cost structure. Whatever it is, it's got to be deep and wide. And if you want the perfect example of a company with a massive economic moat, look no further. This is what Buffett is saying here. The brand power of Coca-Cola is so strong, so embedded in the minds of billions of people around the world, that even if you had $100 billion, you couldn't build a competitor to dethrone them. It just can't be done. That is a moat. So how does he stay so disciplined? I love this. He uses this little mental trick. Imagine you get a punch card when you're born, and it only has 20 slots on it. And that's it. That's all the investments you get to make for your entire life. Suddenly, you'd think really, really hard about each punch, wouldn't you? You wouldn't waste one on some silly fad. You would wait, you would do your research, and you would only swing at the absolute best pitches. Now, it is so important to remember that Buffett didn't just invent all of this in a dark room by himself. The guy is a learning machine. He spends something like 80% of his day just reading, and he learned these universal principles by studying the lives of other people who built incredible things. And this is just a short list of the kinds of people he studied. You've got Ray Kroc building the systems of McDonald's, Sam Walton's obsession with value at Walmart. Each one of them mastered a core principle that you can see reflected in Buffett's own philosophy. But one person he admired, maybe more than almost anyone, was a woman named Rose Blumkin, Mrs. B. This was her entire business plan. That's it. So simple, so powerful. She built this massive company, the Nebraska Furniture Mart, on this one idea. Buffett was so blown away by her that he basically said, forget business school, just go study what she did. It's a total masterclass in creating value and operating with absolute integrity. So you've done the work. You've built something, that's awesome. But the job isn't done. Now you have to protect it. This is all about building that fortress around what you've earned, making sure that one storm, one bad bit of luck, doesn't tear it all down. This might be the single best explanation of diversification I have ever heard. It is just brilliant. Imagine you own a suntan lotion company. Your business does great, but only when it's sunny. Now imagine you own an umbrella company. You only make money when it rains. But what if you owned both? See? Now you don't care what the weather does. When one is down, the other is up. You've smoothed out the ride. That's diversification in a nutshell. Now, part of building a fortress is understanding the risks, and the ultimate risk in business is failure, which usually means bankruptcy. It's important to know there are different kinds. Chapter 11 is a reorganization. The company is in trouble, but it gets a chance to restructure and try to survive. Chapter 7, that's liquidation. It's game over. The company is shut down and its assets are sold off. Which brings us to our final section, and honestly, the most important one. After a whole lifetime spent building this incredible machine of wealth and knowledge, what's the point? What is all of this for? For Warren Buffett, the answer couldn't be more clear. I mean, just let that number sink in for a second. More than 99%. This is a man who still lives in the same house he bought back in 1958. For him, this enormous fortune was never about buying yachts or islands. He sees it as a tool, a resource, to be redeployed back into society to help solve the biggest problems. It's absolutely staggering. And this quote, which was highlighted in the material, just captures that spirit perfectly. It's not about charity being a nice thing to do if you have extra. It's a fundamental duty. It's the price of admission for having a meaningful life. It's the rent we all pay for our time here. So as we wrap this up, the final question has to turn back to you. We've seen Buffett's blueprint for how he built his life's work and what he's chosen to do with it. His story is a testament to what is possible. So the real question is, what will your blueprint build? What will your legacy be? Have you ever really thought about what it takes to be financially free? I'm not just talking about being rich, but, actually fulfilled. Well, today, we're going to try to find some answers by looking at the life and the mind of maybe the greatest investor of all time, Warren Buffett. We're going to dig into the principles that took him from just a kid in Omaha to a true global icon. So, to really get a sense of his success, let's just start with a number. We're talking about a net worth of around $80 billion. I mean, that's just a mind-boggling amount of money, right? It's almost impossible to wrap your head around. But here's the crazy part. That number, it's actually the least interesting thing about him. See, for Buffett, it was never, ever just about the cash. This quote right here, it really gets to the core of who he is. The guy literally loves what he does. He found something he's so passionate about that work basically became play for him. So the big question is, how does a guy who has this much fun at his job also end up as one of the richest people on earth? All right, so here's how we're going to break this down. We've got 5 parts. First, we'll meet the man himself. the Oracle of Omaha. Then we're going to jump back to see how he got started as a kid. After that, we'll get into his core mindset, his inner scorecard. Then we'll look at his method, the snowball effect. And finally, we'll wrap up with the legacy he's leaving behind. Sound good? Let's go. So who is this guy, really, when you look past all the billions? Well, yeah, he's a legendary investor, for sure. But he's also one of the biggest philanthropists in history. And on top of all that, he's famous for being just a really down-to-earth guy with a great sense of humor who's not afraid to make fun of himself. And this quote just perfectly captures his personality, doesn't it? People asked him about his diet. He famously eats burgers and drinks cherry Coke all the time. And this was his answer. It just shows you, this is a man who lives life completely on his own terms, always with that little twinkle in his eye. It makes him seem way more approachable than you think a billionaire would be. Okay, to really get this guy, we've got to go way back. His story doesn't start in some fancy Wall Street office. Nope. The groundwork for all his success was laid way, way before he was a billionaire. It started back when he was just a kid in Omaha, Nebraska. A kid with this unbelievable drive to just work and make his own way. I mean, look at this. The speed at which he started is just incredible. At 6 years old, he's already out there selling gum and Coca-Cola. By 11, he's buying his first stock. At 13, he's filing his first tax return. And by the time he's 15, he's used his profits to buy farmland. This was not some kid's hobby, okay? This was pure hustle. This was the start of an empire. So what's the big takeaway from all this? Well, Buffett's childhood basically boils down to 2 huge lessons. Number 1, start early. Time is your single biggest advantage. And number 2, you just can't beat good old-fashioned hard work. I mean, the guy delivered almost 600,000 newspapers as a teen, getting up before 5 in the morning to do it. That kind of work ethic, that was just who he was. It was non-negotiable. But, just working hard isn't quite enough. You've got to have the right mindset, too. And this brings us to what might be the single most important idea he ever learned, something his dad taught him. He calls it the inner scorecard. Think of it like an internal compass that has pointed him in the right direction for every big decision he's ever made, in life and in business. So what is that exactly? Well, living by an inner scorecard just means you live by your own rules, your own judgment. You do what you think is right. The opposite of that is the outer scorecard. That's when you're always worried about what other people think, what they'll say, whether they'll praise you or criticize you. And Buffett says that choosing between those two, it's one of the most important choices you will ever make. And he has this kind of provocative question to explain it. It's a little out there, but man, does it get the point across. The person who lives by that inner scorecard, they know the truth about themselves, and they really don't care what other people think. And that philosophy, that's what let him buy stocks when everyone else was selling in a panic. It's what lets him live in the same modest house for decades, even though he could afford anything. So this mindset, it leads to a couple more really important tips. First off, you've got to have the guts to trust yourself and not just follow the crowd. And second, you got to be able to laugh at yourself. People who have that strong inner scorecard, they're usually confident enough that they don't take themselves too seriously. And that is a trait Buffett has, let me tell you, in spades. All right, so we've talked about his work ethic, we've talked about his mindset. Now, let's get into the method. How did he actually do it? How did he turn those early savings into this unbelievable fortune? Well, it all comes down to one big idea, an idea he likes to compare to a snowball rolling down a hill. And that snowball is the magic of compound interest. It's basically interest earning more interest on itself. It just grows and grows faster and faster over time. And Buffett's metaphor here is just perfect. Life is the snowball. The wet snow you need to pick up, that's a good investment. And the really long hill, well, that's time. And because he started so early, his snowball had a very, very long hill to roll down and get bigger and bigger. So the question is, how do you find that wet snow? How do you find those good investments? Buffett's answer is actually pretty simple, but it is so powerful. He says the absolute best investment you can ever make is in yourself. Before you can grow your money, you've got to grow your mind. And listen, that's not just some nice-sounding platitude. It is a cold, hard financial fact. Just take a look at this data. We're not talking about earning a little bit more with more education. On average, someone with a professional degree earns more than triple what someone without a high school diploma makes. Triple. That, right there, is the power of investing in your own knowledge. But just having knowledge in your head isn't enough if you can't get it out. Buffett is convinced that just by getting better at communicating, you could boost your lifetime earnings by 50%. Think about that. Because if you have the most brilliant idea in the world, but you can't explain it to anyone, it's useless. It really is like winking at someone in a pitch black room. You know what you're doing, but nobody else has a clue.
And when we say communication, it's really four things, right? It's speaking, it's writing, it's listening, and it's how you deal with people. Get this. Buffett used to be absolutely terrified of public speaking, so he went and took a Dale Carnegie course to get over it. And today, the only diploma he has hanging on his office wall is the certificate he got from that course. That's how important he thinks this stuff is.
And finally, holding this whole method together is one core principle: integrity, an absolute, unwavering commitment to it. This quote, he said this to Congress during a major crisis, and it just says everything. You can always make money back, but your reputation, once that's gone, it is gone for good. For Buffett, integrity isn't just some nice moral idea. It's the absolute foundation of good business, period. So we've seen how he built this massive fortune. But the last chapter of his story, it's all about what he's doing with it now. And honestly, this might be the most incredible part of his entire life, because it's not about hoarding the wealth. It's about giving it all away. That's the number. Over 99%, Warren Buffett has pledged to give away basically his entire fortune to charity. I mean, if that doesn't prove that his life was never about buying yachts and fancy cars, I don't know what does. It was always about the love of the game, the intellectual challenge of building something truly great. I mean, his legacy is going to be defined by that unbelievable generosity. He actually co-founded the Giving Pledge with Bill Gates, getting other billionaires to promise to give away at least half of their money. His whole philosophy on this is crystal clear. If you are lucky enough to have that kind of fortune, you have a massive responsibility to everyone else. And that really brings us all the way back to you. Because these ideas, starting early, working hard, having that inner scorecard, investing in yourself, these aren't just rules for billionaires. They're universal truths for building any kind of successful, meaningful life. So at the end of the day, the only real question is, what's your first step going to be? You know, when you hear about legendary investors like Warren Buffett, it's easy to picture some kind of math genius with a supercomputer for a brain, right? But what if the real secret to success, the actual key, is something that has nothing to do with being a genius? In fact, it's something we all have access to. So in this explainer, we're going to unpack the core mindset behind successful investing using the wisdom of the master himself as our guide. And I'm telling you, you might be surprised to find his most important lesson has nothing to do with stock charts or fancy formulas. And boom, there it is, right out of the gate. Temperament, not intellect. Just let that sink in for a minute. We're talking about a world filled with PhDs, complex algorithms, and high-frequency trading. And the most successful investor of all time says the most important quality is your personality, your character, how you handle your emotions. It's kind of a wild thought. This one idea is the foundation, the bedrock, for everything else we're going to talk about. So let's explore what this winning temperament actually looks like in practice. All right, first up, the first pillar of a great temperament is simply patience. And absolutely nothing rewards patience more than the miracle of compounding. Seriously, this is the one concept that can turn a small amount of money into a truly staggering fortune. But, and this is a big but, only if you have the discipline to let time do all the heavy lifting. Let's just run a little thought experiment here. Imagine a 20-year-old somehow manages to scrape together $10,000. Instead of spending it, they invest it, and then they just leave it alone. For a long time. We're talking 80 years, until they hit 100. What do you think happens to that initial 10 grand? So, go on, take a guess. What number pops into your head? Let's say we put that $10,000 into a portfolio of what are called small cap value stocks, basically just smaller companies that the market might be undervaluing. If that money grows at its historical average of about 14% a year, what does it become? $1 million? 10 million maybe? $357 million. Yeah, just let that sink in. That's not from some complex, risky day trading strategy. That is the raw mathematical power of compound interest when you just give it enough time to work its magic. It's a truly incredible result. But, okay, let's kick it up a notch. What if instead of that solid market average, our $10,000 grew at Buffett's actual historical annual return of 20%? Now, it's only a 6% difference per year.
How much of an impact could that really make?
$21.6 billion with a B from 10,000. I know, it almost sounds impossible, but it's just math. This shows you the unbelievable leverage that just a few extra percentage points in your annual return can have when they're compounded over a lifetime. The difference is just astronomical.
Now, here's what's so interesting, and this chart shows why temperament is so crucial. Look at that graph. For the first 20, 30, even 40 years, the line is almost flat. It looks like nothing is happening. It's boring. All the explosive, life-altering gains, they happen in the later decades. Without the patience to wait through those early, quiet years, you never get to see the incredible fireworks at the end. So that graph shows us why we need patience. But having that kind of patience when it feels like nothing's happening, well, that requires a very specific kind of discipline, the ability to delay gratification. It's that classic choice between enjoying something small today and waiting for something truly great tomorrow. And as it turns out, this is not a new idea at all. I mean, look at this. It's brilliant. You've got Aesop's fables from over 2,500 years ago talking about how a bird in the hand is worth two in the bush. Then you fast forward to the 1960s, and you've got Stanford's famous marshmallow experiment doing the same thing. Kids who could resist eating one marshmallow right away in exchange for getting two later, well, they were found to have more successful life outcomes across the board. Whether it's a bird in the bush or a second marshmallow, the principle is exactly the same. And Buffett himself defines investing in these exact terms. It's the simple act of giving up something today, laying out money now, with the specific goal of getting more money back in the future. And he adds that crucial little detail, more money in real terms, which just means after you account for inflation. It really is the ultimate marshmallow test for adults. Okay, so a successful temperament needs patience and discipline. The third pillar is a calm, rational approach to risk. To stay invested long enough for all that compounding to work, you have to be able to handle the inevitable ups and downs without panicking. And that starts with just understanding what risk actually is. While you'll hear finance folks talk about beta or standard deviation, Buffett, as usual, just brings it all back to simple common sense. For him, risk is the dictionary definition, the possibility of loss or injury. It's not about the market bouncing up and down, that's just volatility. Risk is about the very real chance of putting money in and getting less money out for good, a permanent loss of your capital. And focusing on that is what keeps a rational investor grounded. Now that said, the academic view does show us a fundamental trade-off. If you look at nearly a century of data, you see a really clear pattern. The safest stuff, like treasury bills, had the lowest returns. Government bonds gave you a bit more return with a bit more volatility. And US stocks, they delivered the highest returns by far, but they also came with the most volatility. That standard deviation number is basically just a way to measure how wild the ride was from year to year. And this chart just visualizes that relationship perfectly. You can't get those high stock-like returns without being willing to accept the high stock-like volatility that comes with them. Over the long term, higher risk has been rewarded with higher return. But in the short term, that risk can feel, well, pretty darn uncomfortable. So here's the crucial point. That volatility we just saw, that's the price of admission for higher returns. It's the test. The people who lack the temperament, the impatient, they get scared by the ups and downs and they sell at exactly the wrong time. But the people who have the right temperament, the patient ones, they endure the volatility and they are ultimately the ones who get rewarded for it. So if we know risk is just part of the game, how does a prudent temperament guide us to manage it? Well, the answer is one of the very few free lunches you'll ever find in finance: diversification. It's the practical strategy that flows directly from a desire to protect yourself from getting wiped out. And once again, this is not some newfangled financial strategy. This is ancient wisdom. We're talking 400 years ago, Cervantes wrote in Don Quixote that a wise person doesn't venture all his eggs in one basket. The logic is simple and it's eternal. If that single basket drops, you've lost everything. Even Shakespeare understood diversification. In The Merchant of Venice, his character explains that because his business is spread across different ships and different locations, he isn't worried. And that last part is key. Therefore, my merchandise makes me not sad. See? Diversification is a strategy for peace of mind. And here's the legendary banker J.P. Morgan bringing this whole idea directly into finance. When a friend complained that he was losing sleep over the market, Morgan gave him this simple advice. The goal isn't just to maximize your returns at all costs.
It's to build a portfolio that lets you sleep at night. Your mix of assets should match your personal risk tolerance. It should match your temperament. So, we've covered the power of time, the discipline of choice, a rational view of risk, and the timeless wisdom of diversification. Let's tie it all together and see what it means for the one person who matters most on your financial journey. So, when we put it all together, what have we really learned? It's that Buffett's genius isn't hidden in some secret formula. It's a philosophy. It's the simple understanding that true wealth is built by harnessing time through compounding, that it requires the discipline to choose the future over the present, and that you have to protect it all with the simple wisdom of diversification.
And that leads us to the final and most important question. It's not about what you know, but about who you are. The greatest challenge in investing isn't conquering the market, it's conquering yourself. You've seen the principles. The real question is, do you have the temperament to actually put them into practice?
All right, let's talk about money. Today, we're going to build your financial house, brick by brick. We're starting with the absolute foundation. Like, where do you even keep your money to make sure it's safe? And we're going to build all the way up to the roof, that mysterious, all-powerful 3-digit number that can either open doors for you or slam them right in your face. Yep, we're talking about your credit score. So let's lay that first brick. You know, to get started, let's tackle a question our grandparents might have actually argued about. Is your hard-earned cash really safer stuffed under a mattress than it is sitting in a bank? It sounds kind of ridiculous today, but there's a very real and very painful history behind that fear. And understanding that is really the first step to building a solid financial foundation. So here's our game plan. First up, we're going to talk banking on safety, so your money has a secure home. Then, we'll get into the everyday money tools you use to move it around. Next, and this is a big one, we'll dive into credit. Is it a friend or a foe? After that, we'll decode your financial report card, your credit score, and we'll wrap it all up with some really important warnings from the one and only Warren Buffett. Okay, part 1. Let's get right to it. That mattress. It feels safe, right? It's tangible. It's hidden. But as we're about to see, in today's world, it might just be one of the riskiest places you could ever decide to keep your money. So you have to picture this. It's the 1930s, the Great Depression. Thousands of banks just failed. They went under. And when they did, people's entire life savings, poof, they just vanished. It was a national nightmare. So in response, the U.S. government had to step in and create a safety net. It's called the Federal Deposit Insurance Company, or FDIC, and its whole job was to make sure that what happened then could never, ever happen again. And this number right here shows you just how powerful that safety net is. The FDIC insures your deposits up to $250,000. That's per person, per bank. It means that if your bank goes belly up tomorrow, the federal government guarantees you will get your money back, all the way up to that limit. I mean, think about the 2008 financial crisis. A lot of banks failed, but not a single person with an FDIC-insured account lost a penny, not one. Your mattress, on the other hand, it's vulnerable to fire, theft, or you're just forgetting which mattress you hid it in. It just can't compete. But you know, safety isn't just about where you put your money, it's about having money there in the first place, for when life throws you a curveball. Buffett's philosophy is all about self-reliance. For you and me, that translates to one thing, the rainy day fund. Having 3 to 6 months of living expenses tucked away in a safe savings account is what keeps you from having to rely on the kindness of strangers, or worse, a high-interest credit card. It's the buffer between a problem and a total disaster. So, your money is safe. Great. But money isn't just meant to sit there, right? It's meant to move. So now let's look at the tools that make that happen, from the really old school to the stuff that's right there on your phone. I know what you're thinking. This thing looks like it belongs in a museum, right? But the paper check, believe it or not, contains the DNA of every single modern payment. It's got the who, the how much, and, most importantly, the where. See those numbers at the bottom, the routing and account numbers? That is the secret sauce of the entire banking system. Everything that happens electronically today is just a faster, digital version of what's happening on this piece of paper. And this is the perfect way to think about it. A paper check is like snail mail. It gets there, but it takes a while. An electronic payment, or what they call an ACH transfer, that's like sending an email. It's practically instant, there's a perfect digital trail, and you don't have to wait for the mailman. It's just a way more efficient way to do the exact same thing. And now, of course, we don't even have to think about routing numbers, do we? Apps like Venmo and Zelle have basically put a bank branch in our pocket. Sending money is as easy as sending a text message. Venmo even made it social, which is kind of weird, but hey, this is where we are now. Instant, frictionless, and totally mobile. And that ease, that frictionlessness, it's the perfect lead-in to our next topic. Which brings us to part 3. And honestly, this might be the most important part of our whole conversation, credit. So what is it? A fund or a foe? Well, the real answer is, it's both. It's one of the most powerful financial tools you can possibly have, but it is absolutely a double-edged sword that demands your respect and a deep understanding. Okay, this right here is the single most important distinction in all of personal finance. A debit card uses your money. It's a direct pipeline to your bank account. Simple. A credit card, on the other hand, uses the bank's money. It is a loan, period. Every single time you swipe it, you are taking out a short-term loan that you are legally obligated to repay. Forgetting this simple fact is how people get into a world of trouble. And here is the cost of that trouble. If you don't pay back that loan in full at the end of the month, the bank charges you interest. And we are not talking about a small fee. An annual percentage rate, or APR, of 18% is pretty common. That debt starts to grow on itself, and it grows fast, working against you 24/7. I love this story about Warren Buffett. A friend came to him asking for a hot stock tip. Instead of giving her one, he asked her, "Do you have any credit card debt?" And she did, at 18% interest. Buffett told her flat out that the best investment she could possibly make was to pay off that debt. Why? Because paying it off gives you a guaranteed 18% return on your money. He said he couldn't guarantee an 18% return on anything else in the world, but she could get it just by paying her bill. It's such a powerful way to look at it. And here is Buffett's warning for anyone caught in that debt trap. Just paying the minimum required each month is a total loser's game. The interest piles up so fast, your payments barely make a dent. His analogy is just perfect and brutal. He says it's like trying to bail out a sinking ship with a teaspoon. You're going down, and that tiny payment isn't going to save you. So all of these habits, how you save, how you spend, and especially how you borrow, guess what? They're all being tracked, and they all get rolled up into your financial report card. So for part 4, let's pull back the curtain and demystify this thing we call a credit score. So what the heck goes into this magic number? Well, the FICO score is made of 5 basic ingredients. But look how they're weighted. It is not as complicated as it looks. Payment history, just paying your bills on time, is 35% of your score. The amount you owe is another 30%. That's it. If you get those 2 things right, you've already mastered 2/3 of the entire game. Everything else is pretty much secondary. Now here's a story that should make everyone sit up and listen. Warren Buffett, yeah, that Warren Buffett, checked his own credit report and found an error. An imposter had fraudulently opened a credit card in his name. Now just think about that for a second. If it can happen to him, one of the most famous people on the planet, it can absolutely happen to you. You have to check your credit report regularly. It's just basic financial hygiene. And why does it matter so much? Because that score is your reputation. Lenders literally sort you into categories. If you're in that prime category, 740 or above, you get the red carpet treatment. The best interest rates on mortgages, car loans, you name it. That saves you thousands, maybe tens of thousands of dollars over your lifetime. But if you fall into the subprime or poor categories, borrowing money gets incredibly expensive, if you can even get approved at all. Your score literally determines the price you pay for money. All right, let's bring it all home. In our final section, we're going to look at some of Buffett's biggest warnings. These are the core principles that can help you avoid major financial disasters and really tie all of this together. This right here, this is the financial penalty box you want to avoid at all costs. Bankruptcy is the legal last resort for when your debts have become completely overwhelming. And while it can offer a fresh start, it absolutely demolishes your credit score for 7 to 10 years. It makes it incredibly difficult and expensive to get back on your feet. It's the ultimate consequence of a financial foundation that has completely crumbled. So let's distill this all down to Buffett's bottom line. First, be self-reliant. Build that rainy day fund. Second, treat credit cards as a convenience, not a source of cash to be raided. That's what your savings are for. Third, be your own financial watchdog. Check your credit report for errors. And finally, a more modern warning from him, be very wary of speculative things like Bitcoin, which he sees as a mirage because it doesn't actually produce anything of value. And there you have it. That's our foundation. You can see how each block, From saving to spending to borrowing, it connects directly to all the others, and it supports the entire structure. So the only question left is for you. After seeing how it all connects, which part of your financial foundation will you focus on first? We hear about the stock market pretty much nonstop. But what if I told you there's another market, one that's way, way bigger, that quietly dictates everything from the rate on your mortgage to whether your city can build new roads? Today, we're going to pull back the curtain on the world of bonds. I know, it might sound a little complicated, but stick with me because by the end of this, you'll see it's the very foundation of our entire global economy. Let's jump in. And to really get our heads around the power of bonds, we've got to start with this powerful way of thinking from Warren Buffett. He says interest rates are like economic gravity. Just let that sink in for a second. It's this invisible force that's constantly pulling on the value of every single investment out there. And that is the key to unlocking everything we're going to talk about today. All right, so here's the game plan. First up, we're going to get a really simple, practical answer to the question, what even is a bond? Then we'll take a tour of the huge bond universe, from the absolute safest to some stuff that's frankly pretty strange. After that, we'll meet the real puppet masters, inflation and the Fed, the forces that pull all the strings. And finally, we'll circle all the way back to Buffett for his final verdict, one that might just flip how you think about safe money forever. All right, let's dive right in. The most fundamental question, what exactly is a bond? Forget all the Wall Street jargon for a minute. We're going to connect this to something you almost certainly already deal with. Okay, at its heart, a bond is just a loan. That's it. It's an IOU. When you buy a bond, you are literally lending your money to a big company or even the government. And in return for that loan, they promise you two things. One, they'll pay you regular interest payments. And two, on a set date in the future, they'll give you your original money back. That's called the principal. See, it's the total opposite of a stock. With a stock, you own a tiny piece of the company. With a bond, you're not an owner, you're the bank. And this right here, this is where it's all going to click for you. If you have a mortgage or a car loan or student loans, guess what? You already get how bonds work. You're just used to being the borrower, the one writing the checks every month. When you buy a bond, you just flip the whole script. You become the lender. You become the one who gets to sit back and collect those steady payments. Okay, so now that we know what a bond is, let's take a little tour of the bond universe. And trust me, it's a huge and varied place, stretching from some of the most rock-solid investments on the planet to some truly bizarre financial creations. We have to start at the center of this universe, with what are widely considered the safest investments in the world, U.S. Treasuries. They're backed by the full faith and credit of the U.S. government, which is just a fancy way of saying the government's ability to tax its citizens and, if it has to, print money means you're going to get paid back. They come in different flavors based on how long they last, from short-term T-bills to long-term 30-year T-bonds. Oh, and there's a special kind called TIPS, which are designed to protect you from inflation. And that's a beast we'll be talking a lot more about very soon. So this graph you're looking at is called the yield curve, and it tells a really simple story about time and money. The yield is just your total return. And see how the line normally goes up and to the right? Well, that makes perfect sense, right? You would naturally demand a higher interest rate, a higher yield, to lock up your money for 30 years than you would for just 3 months. It's your reward for taking on the risk of the unknown future. By the way, it's when this curve flips upside down, an inverted yield curve, that's when economists really start to sweat, because it's been a spooky good predictor of recessions. Of course, it's not just the federal government that needs to borrow money. Huge companies like Apple and Nike issue corporate bonds to raise cash for building new factories or developing new products. The big difference here, they can't print money. So there's always what's called default risk, a small chance they could go bust and not pay you back. Then you have muni bonds, which are issued by your state or city to fund projects like schools, bridges, and roads. And the big hook for these is often that the interest you earn is tax-free. So how do you actually measure all that default risk? Well, investors look to rating agencies. Think of them like credit score companies, but for bonds. They give each bond a grade. Anything from AAA down to BBB is called investment grade, which means the odds of default are considered super low. But anything below that, well, the polite term is high yield. The more common term, junk. The trade-off is simple. You're taking on a lot more risk for the chance at a higher return. And speaking of junk bonds, Warren Buffett has a pretty classic Buffett take on them. It's a funny line, but it's also a pretty sharp warning. For professional investors who live and breathe this stuff, maybe it's a different story. But for most everyday people, that extra little bit of yield often just isn't worth the very real risk of losing everything. And just to wrap up our tour, I've got to show you how weird and wonderful this universe can get. Meet the Bowie bond. Yep, back in the 90s, David Bowie took all the future money he was going to make from the royalties of his classic songs, bundled it all up, and sold it to investors as a bond for $55 million. It just goes to show you, if an asset produces a predictable stream of cash, you can bet someone, somewhere, has figured out how to turn it into a bond. So we've covered what bonds are and all the different types out there, but now we have to get to the really important question. Why do their prices and interest rates move around so much? To understand that, we have to look behind the curtain at the two big puppet masters pulling all the strings, inflation and the Federal Reserve. First, let's talk about inflation. You feel this every time you go to the grocery store or fill up your car. It's just the steady increase in the cost of living. And what it really means is that your dollar today will buy you less stuff tomorrow. For a bond investor who's been promised a fixed dollar payment for years into the future, inflation is public enemy number one. It's like an invisible tax, silently eating away at the real value of your money. So how do they even measure this stuff? Well, the government's main tool is something called the Consumer Price Index, or CPI. You can think of it as a giant, standardized shopping list, a basket of all the stuff an average family buys. And just look what's in the basket. Housing is the giant here, making up more than 42% of the whole thing. Throw in transportation and food, and you're looking at almost 3/4 of the entire measurement. So when the prices of these big ticket items go up, the official inflation number goes up with them. So whose job is it to try and tame this inflation beast? In the United States, that massive responsibility falls to the Federal Reserve, the Fed. It's the country's central bank, and Congress has given it two main jobs, what's called the dual mandate. Job one, keep prices stable, which means keeping inflation under control. And job two, promote maximum employment, which means keeping the economy healthy. And believe me, it is a very tricky balancing act. So how does the Fed actually do this? Well, it's got three main tools in its toolbox. It can change reserve requirements. That's how much cash banks have to keep on hand. It can change the discount rate, which is the interest rate banks pay to borrow directly from the Fed. But its biggest, most powerful tool by far is number three, open market operations. This is where the Fed goes into the market and buys or sells massive amounts of government bonds. By doing this, they can either pump money into the system to push interest rates down or pull money out to push them up. They are literally adjusting that economic gravity we talked about. Okay, so all of this brings us to the final and most important question. We're all taught that bonds are the safe part of our investments, the responsible choice. But after everything we've just learned, we have to ask, are they really a safe haven? Or, when you look at the long term, could they actually be a trap? Here are the two sides of the argument. On one hand, you have the conventional wisdom, bonds are safe haven. And you know what? If your goal is short-term, like you're saving for a house down payment in a couple of years, and you absolutely cannot afford to lose your original investment, that is largely true. But when the conversation shifts to building real wealth over decades, Warren Buffett comes in and throws a huge wrench in that whole idea. He argues that this perceived safety is an illusion. In his view, it's a trap. I mean, listen to this. This is from his 2011 letter to shareholders, and it is an absolute bombshell. He wrote that currency-based investments, the very things we're told are safe, are, in truth, among the most dangerous of assets. How could the most successful investor of all time say something that sounds so completely backward? The answer is this number, 86%. In that very same letter, Buffett pointed out that from 1965 to 2011, the US dollar lost 86% of its purchasing power. Something that cost $1 in 1965 cost $7 by 2011. That is the silent, devastating power of inflation over a long period of time. So here's Buffett's whole argument in a nutshell. As a long-term bond investor, you get slammed by a brutal 1-2 punch. First, you get hit with the invisible tax of inflation, which makes every single fixed payment you receive worth less and less. Then you get hit with the visible tax from the government on the interest you earn. So after you've been taxed not once, but twice, your real return, your actual gain in purchasing power, can often be zero, or even worse, negative. You think you're getting ahead, but you're really just running on a financial treadmill, going absolutely nowhere. And so we're left with this final, really powerful question to think about. In a world where that invisible tax of inflation is always working against your savings, we have to completely redefine what risk actually means. Is the bigger risk owning a piece of a great, productive business that can raise its prices to keep up? Or is the true risk playing it safe with an investment that is almost guaranteed to lose its value over time? That's a critical question for anyone trying to build a secure future. Thanks for digging into this with me.
All right, let's talk about the stock market. It can seem like this incredibly complex, maybe even intimidating world, right? But what if I told you that at its core, it's really built on just a few simple, powerful principles? In this explainer, we're going to strip away all that noise and get right down to the fundamentals. We're going to demystify how this whole thing actually works, right from the very beginning. So let's dive in.
And we're going to kick things off with this absolute gem from the master himself, Warren Buffett. This one sentence, this is more than just a clever quote. It's really the guiding philosophy for our entire journey today. It's a reminder that the market isn't just about spreadsheets and algorithms. It's about people. It's about human nature.
So here's our game plan. We're going to follow the entire life of a stock. We'll start with the most basic question of all. What even is a stock? Then we'll watch how it's born in something called an IPO, how it lives and breathes on the exchange, how we can start to categorize it, and finally, we get to the fun part, the great game of how investors try to win. Let's get to it. Okay, Chapter 1. What is a stock? Before we can talk about markets, trading, all that exciting stuff, we have to understand the thing itself. So, when you buy a stock, what are you actually buying? It's this simple, but this is probably the most important concept we're going to talk about today. A stock is not a lottery ticket. It is not just a bunch of letters flashing on a screen. It is a small, tangible piece of ownership in a real business. So if you own just one share of Apple, you literally own a tiny fraction of the entire company. The buildings, the brand, the patents, the whole shebang. And hey, this isn't some new idea I just came up with. This is timeless wisdom. Warren Buffett drilled this into his head, and he learned it from his own mentor, the father of value investing, Benjamin Graham. It is the absolute bedrock of his entire philosophy. So remember this. When you buy a stock, you are not just betting on a price, you're becoming a part owner of a business. That brings us to Chapter 2, the IPO. So every single stock that's traded out there had a birthday, and that birthday is called an initial public offering, or IPO. This is that huge moment when a private company, could be a family business, could be a hot new startup, decides to sell shares to the general public for the very first time. So how does that happen? Well, it's kind of like a four-step dance. First, the company hires a big investment bank, like a Goldman Sachs or JP Morgan. Insiders call this the beauty contest because all the banks are competing for the deal. Second, the bankers take the company's management on what's called a roadshow, flying around pitching the stock to huge investors. Third, based on how much demand they see on that roadshow, they all agree on an initial price. And finally, the main event, IPO day. That's when the stock hits an exchange, and anybody, including you, can buy it. Now, this whole process is a massive undertaking, and the investment banks that orchestrate it, well, they get a pretty nice slice of the pie. A typical fee is right around 7% of all the money that's raised. So think about it. If a company raises $100 million in its IPO, that's a cool $7 million payday for the bankers. Now, here's where it gets interesting. The big institutions, they get to buy at that initial IPO price before it even starts trading. But what often happens is that the stock price pops on that first day. It shoots up. This creates an opportunity for those early investors to become what are known as flippers. Yeah, it's just like flipping a house. They buy in at the initial price and then sell just a few hours or days later for a quick profit. Okay, Chapter 3. So the stock has been born. It had its big IPO debut. Now what? Well, now it enters this vast, chaotic, dynamic world of the stock exchange. And this is where its true journey really begins, a world where it might be bought and sold millions of times over its lifetime. Now, this is a really crucial distinction to get. The IPO, that happens in the primary market. That's the one time the company itself sells the stock and gets the cash to build new factories or hire people. But pretty much all of the trading you hear about on the news every single day, that's the secondary market. That's just investors like you and me trading those already existing shares back and forth. Think of it like this. When a company like Topps sells a new pack of baseball cards, that's the primary market. But when you trade those cards with your friends, that's the secondary market.
Topps doesn't get any new money from that trade. And how do we keep track of all this furious trading? With ticker symbols. Today, they're just letters on our phones, but they have a really cool history. Check this out. This is a stock ticker machine built by Thomas Edison's company back in 1880. It would literally spit out this long, thin strip of paper, a ticker tape, with the stock's symbol and its latest price. And yes, this is exactly where the famous ticker tape parades in New York City came from. Pretty cool, huh? So where does all this trading happen? Well, in the US, it's mostly on these three major exchanges. You've got the New York Stock Exchange, the NYSE, that's the historic big board. Then you have the NASDAQ, which is famous for all the big tech companies like Apple and Amazon. You know, back in the day, where a company listed was a really big deal, but honestly, today, the distinction matters a lot less than it used to. Moving on to Chapter 4. Okay, so with thousands and thousands of stocks to choose from, how on earth can investors make sense of it all? Well, they came up with some categories, a system to help classify a stock's identity and figure out what kind of investment it might be. Let me start with a little bit of a brain teaser to challenge how we think about price. Take a look at this. Is it possible for a stock that costs $300,000 for a single share to actually be considered cheap? I mean, it sounds absolutely absurd, doesn't it? But here's the thing. The price tag alone doesn't tell you if something is a good deal. To answer that question, we need a tool. And one of the most common is the P/E ratio. It stands for price to earnings. You just take the stock's price and you divide it by the company's annual profit per share. It tells you how much you're paying for every dollar the company makes. And that $300,000 stock, yeah, that's a Class A share of Berkshire Hathaway. And because the company makes so much money, its P/E ratio is often lower than the average stock. So could you argue that it's cheap? Absolutely. And all of this brings us to this really handy grid that Wall Street uses called the style box. It's a simple way to map out a stock's identity. On one axis, you have size, what we call market capitalization, which is just the total value of all of a company's shares. Is it a small cap, mid cap, or a large cap company? And on the other axis, you have its style. Is it a value stock with a low P/E ratio, or is it a high-flying growth stock that everyone expects to grow like crazy? And now, Chapter 5. This is where we get to the great debate. Once you own stocks, what's the best way to handle them? How do you actually win this game? Well, there are two fundamentally different schools of thought on this. So in one corner, you have the random walk theory. This idea basically says the market is so smart and so competitive that all the news is priced into a stock instantly. You can't outsmart it, so the best strategy is to not even try. Just buy a low-cost index fund and own the whole market. But in the other corner is the idea that, yeah, the market is usually efficient, but it's not always rational. It has mood swings, and in those moments of fear and greed, there's opportunity. And nobody ever brought this idea to life better than Benjamin Graham with his brilliant analogy of Mr. Market. Imagine he's your business partner, but he's a little unstable. Some days he shows up at your door totally euphoric, offering to buy your shares from you at a ridiculously high price. Other days he's in a deep, dark depression, offering to sell you his shares for pennies on the dollar. And Graham's point was genius. You don't have to listen to him. Your only job is to recognize his mood and take advantage of it. Buy from him when he's panicking, and maybe sell to him when he's giddy. And here we are, full circle. Buffett took Graham's whole Mr. Market story and boiled it down into his single most famous piece of advice. This is the practical application. When the market's on fire and everyone is piling in, that is greed, and that is when you should be fearful. And when the market crashes and everyone is running for the exits, that's fear, and that is your moment to be greedy. The ultimate expression of that market greed, of that euphoria, is a bubble. From the tulip mania in the 1600s, when a single tulip bulb literally sold for the price of a mansion, to things we've seen in our own lifetimes, history is just littered with them. And Buffett's warning here is so simple and so clear. Bubbles are exciting, but they cannot last forever. Eventually, reality shows up and it acts like a pin.
So let's bring it all home. Let's recap Buffett's final word on all of this. Number one, the most fundamental truth, a stock is ownership in a business. Never forget that. Number two, for most people, the most sensible path is just to buy a low-cost index fund and own the whole market. But the market isn't always a perfect, efficient machine. It's driven by human emotion. And that means the key is to be ready to act against the crowd, to be fearful when they're greedy, and to always remember that every single bubble is destined to pop.
And so that really leaves us with a final question for you to think about. The market is always going to swing between that optimism and pessimism, between that greed and fear. So when the next great mania takes hold and the bubble starts to inflate and everyone you know is getting swept up in the excitement, are you going to be the optimist who gets caught? Or are you going to be the realist who, guided by these principles, patiently waits to profit from the madness of the crowd?
You know, when you hear the name Warren Buffett, a few famous quotes probably pop into your head. But today, we're going to go deeper than that. We are going to deconstruct his entire philosophy, piece by piece, and build a real, practical framework that you can actually use, all based on his own words. Okay, so here's our game plan. First up, we're getting down to brass tacks. How do you even figure out what a business is worth? Then, we're going to try to get inside his head to really understand the Buffett mindset. After that, we'll dissect what makes a company truly great, and then tackle the really hard part, when to sell, and more importantly, when to do nothing. And finally, we'll wrap it all up with his golden rules.
All right, let's start at the beginning. Before you even dream of buying a stock, you got to ask the most fundamental question there is. What is this company really worth? Let's open up the toolkit.
But hang on, before we even pull out the tools, Buffett gives us this really important warning. What he's telling us here is that a fancy formula can give you a false sense of precision. The numbers are just a guide, not gospel. Remember this, it's so much better to be approximately right than precisely wrong.
So, generally speaking, there are two main roads investors take to get to a price. Over on the left, you've got what Buffett champions, intrinsic value. It's calculated using a discounted cash flow model. Think of it this way. You're trying to figure out all the cash a business is going to spit out for the rest of its life, and then you calculate what all that future money is worth today. It's about valuing the business as a standalone thing. Now on the right is the common Wall Street shortcut, the PE model. It's faster, but it's more about comparing a stock to other stocks, not figuring out its true underlying worth.
So, which road does Buffett take? He couldn't be clearer. He's the first to admit that calculating intrinsic value isn't perfect. It's always going to be a bit fuzzy, an estimate. But for him, it is the only logical way to think. It forces you to think like a business owner, not just a stock trader.
And that leads us perfectly into the next piece of the puzzle. Because, look, having the right valuation tool is one thing, but using it with the right mindset, the right philosophy, well, that's everything. That's what separates the best from the rest.
You know, this might be one of the most freeing concepts in all of investing. You don't have to be an expert in biotech and software and retail and banking. In fact, trying to be is a huge mistake. The real skill is to be brutally honest with yourself about what you truly understand, and then have the discipline to never, ever step outside that circle.
So how do you stay in that circle? Well, Buffett loves this story about the baseball player Ted Williams, who was obsessed with getting a hit. Williams knew he only hit well when the ball was in a very specific part of the strike zone, so he just waited for the pitch to come to him. In investing, the amazing thing is there are no called strikes. You can stand there all day as thousands of companies or pitches go by. You don't have to swing at any of them. You can just wait for that one perfect pitch right in your sweet spot.
And this is exactly why that patience pays off so handsomely. If you own a truly wonderful business, time is your best friend. It just keeps compounding and getting more valuable. But if you own a mediocre, crummy business, well, time is your worst enemy, just chipping away at its value day after day.
Now, this slide shows the single biggest shift in Buffett's entire career. See, he didn't start out this way. He learned from his mentor, Ben Graham, to look for what they called cigar butts. These were awful businesses that were just so incredibly cheap that you could pick one up, get one last free puff of profit out of it, and then toss it. But his partner, Charlie Munger, convinced him that it's a much better life to buy a wonderful business at a fair price than a fair business at a wonderful price.
I mean, seriously, does it get any clearer than that? This one line just captures that entire philosophical shift perfectly. Stop digging through the bargain bin for rhinestones. Focus all your energy on finding a way to own even a tiny piece of the Hope Diamond.
Okay, so we've got the mindset down. We're looking for the Hope Diamond. But what does that actually look like? What's the anatomy of one of these wonderful businesses in the real world?
The whole idea really comes down to this one powerful metaphor, the business moat. You want to own a castle, and you want that castle to be surrounded by a huge, deep, crocodile-infested moat that keeps all the competitors out. That moat is its durable competitive advantage.
Now, this moat can come from a bunch of different places. It could be a brand name that's so powerful it lives inside millions of people's minds, like Coca-Cola. It could be a patent. It could be that you're just the cheapest guy in town, like Geico. Or it could be a massive network that's just impossible for a competitor to replicate.
Just stop and think about that for a second. That is a wild statement. He's saying that even with $100 billion, you couldn't build a business to knock Coca-Cola off its throne. That's the kind of unbreachable moat he's looking for. That is a fortress.
Of course, every great castle needs a great knight running the place, right? You could have the best business in the world, but you need honest, talented, and rational managers at the top to make sure that moat gets wider over time, not narrower.
And here's a trap so many investors fall into. We're taught to just chase growth. But Buffett uses the airline industry as a classic example of a terrible business. Yeah, it grows, but it needs an unbelievable amount of money for new planes, for fuel, just to stay in the game. And historically, they make very little profit. Compare that to a business like See's Candy. It doesn't need much new capital, and it just gushes cash year in and year out.
So, let's say you've done it. You found a wonderful business, in your circle of competence, at a fair price. You bought it. Now what? Now comes what might be the hardest part of all, knowing when to hold on.
You've probably heard that old Wall Street saying, you can't go broke taking a profit? Well, Buffett thinks that's some of the worst advice you could ever get. Selling a truly great business just because the stock went up is, in his mind, a huge mistake. The only time you sell is if the reason you bought it in the first place, the fundamental business, has permanently soured.
And you don't have to look very far to see what that looks like in the real world. I mean, think about Kodak. They had a moat in film photography that looked impenetrable until the digital camera came along and just drained it completely dry. Or Sears. They were the dominant retailer for decades, until Walmart and then Amazon just washed their moat away. Their business story changed, for the worse.
All right, let's bring it all home. We've gone through the valuation, the mindset, the anatomy of a great business, and the art of holding on. It all boils down to just a couple of simple, powerful golden rules.
And there it is, the entire blueprint, right there in one sentence. It's really just a 4-part checklist. 1, it's a good business with great economics. 2, it's run by people you can trust. 3, you buy it at a sensible price. And 4, well, you do those 3 things, and success is practically a given.
And this right here from his partner Charlie Munger is the mic drop. If you take away only one single idea from all of this, let it be this one. Quality first. The quality of the business you're buying is the most important thing, period. Everything else comes second.
So I'll just leave you with this final thought. Forget about the hot stock tip of the week. Forget about trying to predict the next big thing. Instead, just look around at the world you already know and understand. What wonderful business, what hope diamond is hiding there in plain sight, right inside your own circle of competence? You know, think back to when you were in school. You got a report card, right? It was this really clear, simple way to measure how you were doing. Well, it turns out businesses get report cards too. We just call them financial statements. And in this breakdown, we're going to learn exactly how to read them.
And who better to be our guide on this than the man himself, Warren Buffett? He has said for decades that accounting is quite literally the language of business. He and his partner Charlie Munger would be flying blind without these numbers. For them, it is always the starting point.
So here's the way I want you to think about it, laid out side by side. For a student, you've got your grades, you've got your report card, and then your overall GPA. Well, for a business, you have its performance, that's the income statement, and then you have its cumulative record, which is the balance sheet. This is the core idea we're going to keep coming back to. Okay, so here's our game plan. We're going to break this all down into 5 simple parts. We'll kick things off with why this language even matters, then we'll look at the 2 main report card documents, see how Buffett himself actually grades a business, and we'll wrap up with a really important warning about reading between the lines.
So first things first, why should you even care about any of this stuff? Well, look, whether you're an investor, a manager, or maybe you dream of starting your own company one day, being able to understand the numbers, it's completely non-negotiable.
Buffett's advice here is about as direct as it gets. Take accounting courses. You simply cannot evaluate a business if you can't speak its language. It's the foundation that everything else is built on.
All right, let's get into the nitty-gritty. Let's look at the first piece of this business report card, the income statement. I want you to think of this as the grade for a specific period of time, like a single semester, or in the business world, a quarter or maybe a full year.
So the income statement, which you'll sometimes hear called a profit and loss or a P&L, really only does one job. It tells you if the company made money or lost money over that set period. That's it. It's a story with a beginning, a middle, and an end, all leading up to one final score.
Now, to make this real, let's use a company you've definitely heard of, Apple. In their 2019 fiscal year, their very top-line number, their total sales or revenue, was this, just staggering figure, over $267 billion. That's more than the entire economy of some countries. But here's the thing, that's just the start of the story. And here it is. This is the entire report card. You see that massive revenue number right at the very top? From there, it's all about subtraction. We start chipping away different kinds of costs. After the first big cost, we get to gross profit. Then we take away more general costs to find operating income. And finally, way down at the bottom, after taxes, we get to the net income. That's the final grade. Let's walk through those steps.
So that first big chunk that gets taken out is the cost of goods sold, or COGS for short. This is the direct cost of actually making the products, the chips and screens for the iPhone, the labor in the factories, all that stuff. For Apple back in 2019, that was about $166 billion. You subtract that from the revenue, and bam, you've got your gross profit.
But of course, a company has other costs, right? You've got to pay salaries for your marketing team, rent for the Apple stores, and you have to fund all that research and development for the next iPhone. Accountants lump all that overhead into a big category they call selling, general, and administrative, or SG&A. Take that away, and now you have the operating income, which is the profit from the company's main business.
And finally, after you account for taxes and a few other odds and ends, we get to the famous bottom line, the net income. In 2019, Apple pocketed over $57 billion in pure profit. In the world of business report cards, that is a definitive A+. No question.
Okay, so if the income statement is the report card for just one semester, what about the entire school record? From kindergarten all the way to graduation day. For that, we have to turn to the second key document, the balance sheet. And this isn't about a period of time, it's a snapshot, a single moment.
And this right here, this is the key. The balance sheet is the company's cumulative GPA. It's the grand total of everything that has ever happened. Every single profit, every loss, every investment, from the day the company was born right up until this exact moment in time.
Now, the whole thing is built on one beautiful, simple equation. Everything a company owns, those are its assets, has to equal the claims against those assets. And those claims only come from two places. What it owes to other people, those are liabilities, and what's left over for the owners, which is the equity. And it's called a balance sheet for a reason. This equation must always balance. It's not a suggestion, it's a law of physics in accounting.
So let's switch gears and look at the master's own company, Berkshire Hathaway. On the left side, you see everything it owns, all its assets. On the right, you see who has a claim to all that stuff, its liabilities and its stockholders' equity. And just look at the totals at the bottom. They match perfectly. $817 billion on both sides.
Let's just break that down one more time so we're all crystal clear. Assets are all the stuff the company owns. Cash, buildings, inventory, you name it. Liabilities are what it owes to other people, like banks or its suppliers. And stockholders' equity? That's the good part. That is what's left over for the owners after all the bills are paid. It's the gravy.
Okay, so now we know what these reports are. But that's just step one. Now for the fun part. How does an expert like Warren Buffett actually use them to grade a business? It's definitely not about just looking at one number in one report.
He really boils it down to a few key rules, and here are 3 of them. First, he looks long-term. One report card is just a single data point. You need at least 5 years of them to see the real trend. Second, he uses a key ratio to measure performance. He takes that operating income from the income statement, and he compares it to the shareholders' equity from the balance sheet. This tells him how much profit the company is making for every single dollar the owners have put in. And third, he absolutely loves businesses that just gush cash without needing to constantly build expensive new factories to grow.
And this is a masterclass right here. This is what separates the pros from the amateurs. The book value on the balance sheet is just an accounting number. Think of it like the price you originally paid for a house. What Buffett really cares about is intrinsic value, what that house is actually worth today, based on all the rent it could produce for you over its entire life. The two numbers are almost never the same.
All right, we've made it to our final section. And I've got to tell you, this might be the most important lesson of all. Just because the numbers follow the rules doesn't mean they're telling you the whole, unvarnished truth. You have to be a bit of a detective.
And you don't have to take my word for it. Listen to what Buffett himself says here. The official rules for accounting are called GAAP, generally accepted accounting principles. But a lot of managers see these rules not as a guide for being honest, but as an obstacle, a challenge to get around, so they can make the results look as good as humanly possible.
So, let's put a bow on this. What are the crucial takeaways? 1. Accounting is the language. 2. The income statement is a report card for a specific period. 3. The balance sheet is the cumulative GPA. 4. Always look at the long-term picture. And 5. Never ever forget to read these reports with a healthy dose of skepticism.
You now have the fundamental tools. You can decode the performance of pretty much any public company out there. You can speak the language. So the only real question left is, whose report card are you going to read first?
Welcome to The Explainer. Today, we are going to try and get inside the mind of the most successful investor of all time, Warren Buffett. We're going to unpack how he actually builds a portfolio, and maybe more importantly, how he thinks about risk in a way that is completely different from pretty much everyone else. It all really starts with this one, his most famous quote. Now, on the surface, it sounds, well, kind of obvious, right? Maybe even a little simplistic. But the logic behind it is the absolute foundation for everything he does. He's not saying a stock can never go down. What he's saying is, you have to avoid losing your money for good. And this right here is why. Just let this sink in. If your portfolio gets cut in half, a 50% loss, you don't need to make 50% back to get even. You have to double your money. You need a 100% return. The math of digging yourself out of a deep hole is just brutal. So the big question becomes, how do you actually build a portfolio that steers clear of that kind of disaster?
Okay, so here's our game plan. We'll kick things off with the one golden rule you need to understand to build any portfolio. Then, we'll look at the way they teach it in business school and contrast that with Buffett's two very different paths. After that, we'll tear down the whole idea of risk and rebuild it the Buffett way. And we'll wrap up with his 5-point checklist for how he does it.
So first up, the golden rule of investing. Before you can even think about putting stocks together, you have to get your head around this one key idea that makes diversification actually work. And that idea is called correlation.
All it is, really, is a number, a score, that tells you how two different investments behave. You know, are they best friends that move in perfect lockstep? Are they sworn enemies that always move in opposite directions? Or are they just complete strangers who don't even know the other one exists?
And this is where it gets really powerful. So if two assets have a correlation of +1, they're identical twins. Owning both doesn't help you at all. But, and check this out, if you can find two things that are perfect opposites, a correlation of -1, well, that's the holy grail. In theory, you could combine them to build a portfolio with almost no risk at all.
This is the classic example, and it just makes so much sense. Imagine you own two companies. One sells suntan lotion and makes a killing when the sun's out. The other sells umbrellas and, you guessed it, does great when it rains. You put them both in your portfolio and suddenly, you don't care what the weather forecast says. Rain or shine, you're making money.
Okay, so with that idea of correlation in our back pocket, let's take a look at how the academics, the business school folks, take this idea and build a whole system around it. It's called modern portfolio theory.
So way back in the 50s, this economist named Harry Markowitz came up with a really brilliant concept called the efficient frontier. And really, you can just think of it as a menu of the best possible portfolio options. For any level of risk you're willing to take, this line shows you the absolute best return you can get.
And I love this analogy they use. Think of that line as all the hot, fresh food at a buffet. Everything below the line, that's the cold, soggy stuff that's been sitting there for hours. You would never pick it because you could get a better dish for the same price. Your only job is to decide how hungry you are for risk and pick your meal from that top line.
But here's the catch, and it's a big one. This whole academic model is built on looking backwards. It relies on historical data to draw that line. And as you can see, Warren Buffett has some pretty strong feelings about trying to drive by looking only in the rearview mirror. So, if Buffett basically tosses that whole business school approach in the bin, what does he suggest instead? Well, this is where it gets really fascinating, because he actually offers two completely different playbooks. Path number one is for, well, pretty much all of us. He calls us the know-nothing investors, and he means that as a compliment. His advice for us is super simple.
buy a cheap S&P 500 index fund, own a little piece of the 500 biggest American companies, and just get on with your life. But then there's path number 2. This is for the expert, the person who does the work. And for them, he says to do the exact opposite.
And trust me, he puts his money where his mouth is. Just look at this breakdown of Berkshire Hathaway's stock portfolio from a few years back. It is insanely concentrated. I mean, over 2/3 of the entire thing was packed into just 5 companies. That is the definition of betting big on your best ideas.
And this really gets to the core of his philosophy. For Buffett, real safety, real risk reduction doesn't come from owning a tiny bit of 100 different things you barely understand. No, it comes from knowing 6 businesses inside and out better than anyone else. Because like he says, your 7th best idea is probably not going to make you rich.
So this sets up the big showdown, right? It's the business school approach versus the Buffett way. And the whole disagreement really boils down to one simple but absolutely critical question. What even is risk? You see, Wall Street and the academics, they're obsessed with boiling risk down into a single, clean number. And that number is called beta. But Buffett thinks this whole quest for a precise calculation is a huge mistake. He'd much rather be vaguely right than precisely wrong. So here are the 2 camps. The academic view says risk is volatility. If a stock's price jumps around a lot every day, it's risky. End of story. Buffett looks at that and says, that's crazy. For him, risk has nothing to do with those daily price wiggles. Real risk is the chance that you could permanently, actually lose your money because the underlying business goes bad. It's about the business, not the chart. And if you want the absolute best illustration of how he thinks about this, we have to talk about his famous and honestly devastating argument against owning gold. So he lays out this thought experiment. He says, imagine you've got $9.6 trillion, and you have 2 choices. With pile A, you can buy all the gold that has ever been mined in the history of the world. It would make a solid cube about 68 feet tall. Or you could take that same money and buy pile B. And his point is just a knockout punch. He says, fast forward 100 years. Pile B, all that farmland, all those companies, will have produced unimaginable amounts of food, energy, products, and trillions of dollars in cash for its owners. And Pile A, the gold cube, it will still be a cube. It will have produced nothing. It will just sit there. That, in Buffett's mind, is the definition of a truly risky asset. Okay, so if we're going to agree with Buffett and throw beta and volatility out the window, what do we replace it with? How should we actually be thinking about risk? Well, he gives us his own 5-part checklist.
And just look at what he's focused on here. It is all about the business. Can you reasonably predict where it will be in 10 or 20 years? Is the management team smart with your money? Are they honest? Are they working for you? And what price are you paying? Notice what's missing. There's not a single word about stock charts or what the price did last year. It's all about the future of the business.
And that really brings us to the final, crucial question you have to answer for yourself. What game are you really playing? Are you investing to try and dodge the market's day-to-day mood swings, or are you investing to become a part owner of wonderful businesses for the long haul? Because your answer to that question, your definition of risk, that's everything. Thanks for joining this explainer.
You know, if you really want to get fluent in the language of business, to actually understand what's being said on the news or in the boardroom, you've got to know who the star players are. So in this explainer, we're going to get you up to speed on the absolute A-list of the corporate world. And you know, that really is the perfect way to think about it. In sports, music, whatever, there are just certain superstars everybody knows. And if you don't, it kind of feels like you're totally out of the loop. Well, it's the exact same thing in business. The names are just a little different. So that's what we're here for. Think of this as your all-access pass into that world. We're going to introduce you to that A-list and hopefully make this whole universe of stocks and big corporations feel a lot more accessible. I promise, by the end of this, you'll know the names that really do shape our world. Okay, so where do we even begin? I mean, how do you find this A-list? Well, thankfully, we've got a map that's been around for over 100 years. It's called the Dow Jones Industrial Average, and for our purposes, it's the perfect guide to the market's biggest superstars. The easiest way to think about the Dow is like a hand-picked playlist of the 30 most important, most stable companies in the entire U.S. economy. It was put together by a guy named Charles Dow way back in 1896, and his goal was simple: give people a quick, easy way to answer that one big question: what did the market do today? It's pretty much the original market snapshot.
Now, to really appreciate these superstar companies, you kind of have to understand the rules of the game they're playing in. Because the Dow has this really unique way of being calculated, and it gives some companies a whole lot more influence than others. See, the Dow is what's called a price-weighted index, which is, well, it's a little unusual these days. Let's use an analogy. Think back to your final grade in a school class. A company with a really high stock price, let's say $300 a share, that's like your final exam. It carries a ton of weight. But a company with a lower stock price, maybe $50 a share, that's more like a pop quiz. It matters, but it doesn't move your final grade nearly as much. That's totally different from other big indexes like the S&P 500, which are value-weighted. They care more about the company's total size, not just its stock price.
Okay, but wait a second. This is a fantastic question, and it's one that trips a lot of people up. If you're just dealing with 30 companies, how in the world do you end up with a number in the tens of thousands? It just doesn't seem to add up, right? Well, the secret is buried in over a century of tweaks and adjustments. You see, the Dow isn't a simple average anymore. A lot has changed. For one thing, it grew from just 12 original stocks to the 30 we have today. For another, companies don't get to stay in the club forever. They get swapped out. I mean, think about it. One of the original members was the American Sugar Company. Times change. But the single biggest reason for that huge number, the one that really juices the calculation, is something called a stock split. And that right there perfectly explains why companies get replaced. Warren Buffett, as usual, just nails it. Even the biggest, most dominant companies can fall prey to what he calls the ABCs of business decay: arrogance, bureaucracy, and complacency. Once those things set in, a company starts to lose its edge, and sooner or later, it can get kicked right out of the Dow. All right, so let's dig into that big adjustment factor I mentioned, the stock split. It sounds way more complicated than it is. It's really just a bit of financial housekeeping, or as the source material calls it, an accounting sleight of hand. Let's just walk through the numbers. It's actually super simple. Let's say you own 100 shares of a company, and each share is worth $50. Simple math, right? Your investment is worth $5,000. Then, the company announces a 2-for-1 split. All that means is you now own double the shares, 200 of them, but the price of each share gets cut in half, down to $25. So what's the bottom line? Your total investment is still $5,000. Nothing fundamental has changed at all.
It really is that simple. It's exactly like changing a $10 bill for 2 $5 bills. You wouldn't walk away thinking you're richer, would you? Of course not. A stock split works on the very same principle. It's really just a cosmetic change, mostly done for psychological reasons, to make the share price look a little more affordable to smaller investors. And here's Buffett again, dropping some wisdom on us. He's basically warning us not to get too excited about these splits. If you buy a stock just because it's split and seems cheaper, you're not focusing on what really matters, the underlying value of the business. And that kind of thinking, he says, is what leads to crazy, irrational market swings. It's a great reminder to always focus on the business itself, not the accounting tricks.
Okay, so we know the rules, we understand the game. Now it's time for the main event. Let's take a grand tour and actually meet the 30 companies that make up the Dow Jones Industrial Average right now. This, right here, is the A-list of the American economy.
But before we dive into the individual names, just take a look at this breakdown. The Dow isn't just one type of company. It's a really diverse mix from all across the U.S. economy. You've got big players in tech, healthcare, finance, consumer goods. It gives you a really balanced snapshot of what's going on.
First up, you've got the names you probably see and use every single day. We're talking about Apple, one of the most valuable companies on the planet. There's Coca-Cola, a brand you can find in almost every corner of the earth. You've got the stores that define how we shop, Home Depot for all our home projects, and Walmart, the biggest retailer in the world. And then, of course, the cultural icons, McDonald's, Nike, and the magical world of Disney. These are companies that are woven into our daily lives. Next, we have the absolute pillars of our financial and healthcare systems. These are the companies running the core infrastructure of our society. In finance, you've got the companies that move money around the world. American Express and Visa handling our payments, and the banking heavyweights Goldman Sachs and JP Chase. Then in healthcare, you have the giants that are discovering new medicines like Amgen and Merck, the household name Johnson & Johnson, and United Health Group, one of the biggest health insurers out there. And finally, we have the tech and industrial titans. These are the companies that literally build the infrastructure of our modern world. You've got software powerhouses like Microsoft, IBM, and Salesforce that run so many businesses. You've got the hardware guys like Intel and Cisco that form the backbone of the internet. And then you have the heavy lifters, Boeing building the jets we fly on, Caterpillar, making the machines that build our cities, 3M with its thousands of products, and Verizon, connecting us all.
Now look, the Dow is an incredible starting point. It's the established old guard. But in today's fast-moving world, the universe of companies that matters always getting bigger. The Dow is not the whole story.
And this slide right here proves that point perfectly. You've probably heard of the FANG stocks: Facebook, Amazon, Netflix, and Google. I mean, these are newer giants that have completely changed how we live. So why aren't they in the Dow? Well, a big reason goes right back to what we talked about earlier. Because the Dow is price-weighted, a stock like Amazon, with its super high share price, would be like a final exam worth 90% of your grade. It would just throw the whole index out of whack. So, for now at least, they're not in the club.
And of course, we can't just keep our eyes on the US anymore, right? Business is a global game now. You've got these emerging titans from China, like the e-commerce beast Alibaba and the search engine Baidu, and they are becoming massive players on the world stage, shaping the future for all of us. All right, we've met the players, we've learned the rules, so let's bring this all home with some practical, actionable advice from the master himself, Warren Buffett, to help you make sense of all this.
So what are the big lessons here? What should you actually walk away with? First, always be on the lookout for those ABCs of business decay. Second, look for companies that have rabidly loyal customers, companies people build their whole lives around, like Apple. Third, never, ever invest based on hype or some accounting trick, like a stock split. Focus on the real value. And finally, as we're about to see, when you do find a great idea, don't sit on it forever.
And that brings us to this final thought. This is Buffett, with his classic wit, basically making fun of himself for watching Coca-Cola dominate the world for 50 years before he finally invested. It's just a fantastic, powerful reminder for all of us. Keep learning, keep your eyes wide open, and when you see a truly great opportunity, be ready to act. That's really the secret to navigating this whole world of business.
You know, what do things like steel, the smartphone in your pocket, and your social media feed all have in common? Well, they were all brought to us by titans of business, these incredible men and women who didn't just build companies, they literally shaped the world we live in today. So, today, we're going to dig in and unpack the playbook of these absolute legends.
Just let that quote sink in for a second. Warren Buffett is pointing out that your average neighbor today probably lives better than John D. Rockefeller, who was, for all intents and purposes, the wealthiest person in modern history. I mean, think about it. For all his billions, Rockefeller couldn't get a shot of penicillin, he couldn't stream a movie on Netflix, he couldn't even enjoy air conditioning. It's a pretty stunning reminder of the incredible progress that's been driven by commerce and innovation, and that's the engine we're really exploring today.
And that's exactly why looking at these folks matters so much. When you understand their strategies, their big wins, and even their controversies, it gives you a kind of roadmap for our whole economy. This isn't just a history lesson. It's really a blueprint for the present and maybe even a little peek into the future. So, here's our game plan. First, we're going to look at the foundational builders, the guys who laid the groundwork for the 20th century. Then we'll shift to the people who really shaped our modern culture. After that, we'll jump into the digital age with the revolutionaries who rewrote all the rules. And to finish up, we'll pull out some timeless wisdom from their careers that you can actually use.
All right, first up, the industrial giants. I mean, these are the figures who took raw materials like steel and oil, combined them with revolutionary ideas like the assembly line, and really built the economic bedrock of the world we know today.
So let's kick things off with a true, honest-to-goodness, rags-to-riches story, Andrew Carnegie. He was a Scottish immigrant who came to America with basically nothing in his pockets, and he went on to build the very steel skeleton of modern America. Seriously, every skyscraper, every major bridge, it all owes a little something to his vision.
The scale of what Carnegie built was just staggering. He eventually consolidated his entire empire into U.S. Steel, creating the world's very first billion-dollar corporation. But what's really incredible is what he did next. He turned around and systematically gave it all away. He had this belief that the man who dies rich dies disgraced. His fortune went on to fund thousands of public libraries all across the country, basically planting seeds of knowledge everywhere, and built world-class institutions like Carnegie Mellon University. Just amazing.
Next up, we've got a man who didn't just build cars. He completely changed how we live, how we work, and how we travel. Of course, I'm talking about Henry Ford. Ford's real genius was the moving assembly line. I mean, this was a totally radical innovation. It slashed costs so dramatically that the Model T became affordable for the average American family. But think about this. In creating this new world of personal travel, he completely destroyed an old one. The entire industry built around horses and buggies, it just vanished. This is a perfect example of what economists call creative destruction, where an amazing innovation creates something new and in the process makes the old way of doing things obsolete. And now for a name that is basically synonymous with unimaginable wealth, John D. Rockefeller. By a lot of estimates, he was the single richest private citizen in all of modern history. Rockefeller's company, Standard Oil, was the textbook definition of a monopoly. It controlled nearly every single drop of oil in the United States. It got so powerful, so dominant, that the government had to step in and, as you see here, literally break it apart with the hammer of antitrust law. But here's the crazy part. The pieces of that shattered company didn't just go away. Nope. They became the energy giants we still know today. Companies like Exxon, Mobil, and Chevron.
So, while those first titans were building the industrial backbone of the country, our next group, well, they focused on something different, the American consumer. These are the shapers of modern culture, the minds behind the brands and the media that really became a part of our daily lives.
Let me introduce you to Katharine Graham. In an era that was completely dominated by men, she took over her family's newspaper, The Washington Post, and became the very first female CEO of a Fortune 500 company, a true trailblazer. Under her leadership, The Washington Post didn't just break some of the biggest stories of the century, it created an unbelievable amount of value. How much? Well, look at that number. Over 3,000% in stock returns. Now, to put that into perspective for you, the broader market, the Dow Jones, grew just 227% in that same period. That isn't just success, folks. That is legendary performance.
Okay, now we're going to shift gears from the newsroom to the checkout aisle. Let's talk about the man who completely reinvented retail. And he did it from a small town in Arkansas. Sam Walton, the founder of Walmart.
You know, his story is a classic David versus Goliath tale. While all the retail giants at the time, like Kmart and Sears, were focused on the big cities, Sam Walton started what he called his small fry company way out in rural Arkansas. So what was his secret weapon? It was a revolutionary new idea called the Superstore, offering this huge variety of goods all under one roof at the absolute lowest prices possible. And with that simple formula, the little small fry ended up eating the giants for lunch.
This slide right here, it really captures 100 years of media evolution in one single picture. On the left, you've got the old model, William Randolph Hearst's newspaper empire. It's totally top-down. Information flows from one central place out to the masses. But on the right, you have Mark Zuckerberg's model, a distributed network, where billions of us are both the consumers and the creators of information. That is a fundamental shift from broadcast to network, and it brings up all sorts of new questions about truth, influence, and what we consider the public square. And that brings us perfectly to our third group, the visionaries who grabbed the power of the microchip and the internet and used it to create entirely new industries and, really, new ways of living. Our next titan is, of course, Steve Jobs. He was so much more than a CEO. He was a master storyteller, a product visionary who didn't just transform one industry, he did it again and again, from personal computers to music to mobile phones. I mean, his story is the stuff of legend. He helped kickstart the whole personal computer revolution, then he was famously fired from the company he co-founded, only to come back and lead one of the greatest corporate turnarounds in history. He gave us the Mac, the iPod, and the iPhone, products that didn't just sell well, they literally created the future as we know it. So, from a garage in Silicon Valley, we now go to a garage in Seattle. Jeff Bezos started Amazon with a pretty simple idea: sell books on the internet. He ended up building the everything store. So how in the world did Amazon conquer everything? Well, Warren Buffett, who calls Bezos the best executive of our generation, thinks the answer is surprisingly simple, and it's captured perfectly in this quote. It was a relentless, almost obsessive focus on delighting the customer. Everything Amazon did, pioneering fast delivery, constantly driving down prices, it all came from that one core principle. That was the formula that changed commerce forever.
So, after going through all these incredible careers, what can we actually learn? What's the takeaway? In our final section here, we're going to pull it all together and look at some key lessons, many of them highlighted by Warren Buffett himself.
All right, Buffett has basically distilled decades of watching these masters at work into a few core principles. First, from a legendary furniture seller he admired named Mrs. B, sell cheap and tell the truth. Simple but powerful. Second, Bezos' mantra we just talked about, delight the customer. Make them the absolute center of your universe.
Third, a lesson in crisis management from the CEO of GM, Mary Barra. When a problem exists, act now. Just face it head on. And finally, an investing lesson he learned the hard way after missing out on Google. Find companies that have a natural monopoly. A product so good, so dominant, that customers really don't have another choice. It's the ultimate competitive advantage.
You know, we started this journey with Rockefeller and the world he lived in. We ended here. The titans of the past, they built empires of steel and oil. The titans of today have built empires of code and logistics. Now, with visionaries like Elon Musk literally aiming for Mars, it leaves us with a pretty fascinating question to think about. Who are the titans of tomorrow going to be? And what challenges that we think are impossible today will they end up conquering for all of us?
You know, when you think of billionaires, you probably picture private jets, mega yachts, that kind of thing. But what if I told you one of the richest people on the planet, Warren Buffett, built his massive fortune by being, well, incredibly thrifty? It's true. And in this explainer, we are going to dive deep into his smart money mindset. I'm going to show you exactly how to use his habits to build your own wealth.
Okay, here's our game plan. We're going to start by getting inside Buffett's head to really understand his thrifty mindset. Then we'll get practical, talking about how to use free resources and shop smarter. We'll even cover how to cut your daily costs and get into some really creative saving strategies. By the time we're done, you'll have a real roadmap to building wealth.
All right, first things first, we have to start with the why. Understanding the philosophy behind being thrifty is absolutely crucial. It's not what you think, and it's a total game changer.
Let's just start with this powerful idea from the man himself. Read that again. It's not about just saving money. It's about freedom. It's about asking yourself a really important question. Are you in control of your money and your stuff, or is your stuff controlling you? This single idea is the bedrock for everything else we're about to discuss.
So let's get this definition straight. Thrifty is not a dirty word. It is not about being cheap or depriving yourself. It's the exact opposite, actually. It's about being smart, strategic, and totally in control of your money. You know, being cheap is often an emotional, reactive thing. Being thrifty, that's tactical. It's a plan.
And this is just perfect. It tells you everything you need to know. The man literally had his core financial philosophy stamped on his license plate. Can you imagine that? A multi-billionaire driving around with a plate that says thrifty. That wasn't a gag. It was a public declaration of how he built his success.
Okay, mindset is locked in, so where do we start putting this into practice? Well, we start with the easiest, most powerful tool in your arsenal, stuff that costs you absolutely nothing. Think about your local library. Seriously, Warren Buffett famously said he read every single book on investing in the Omaha Public Library. Today, your library card is like a key to a kingdom of free knowledge and entertainment. We're talking physical books, ebooks, movies, internet access, all for $0. It's an unbelievable resource that most people just forget about. And the scale of free information available to us now is just staggering. It's not just your local library anymore. Look at this number, 130 million. That's how many books Google is trying to digitize and make available to everyone, for free. The entire history of human knowledge right at your fingertips. What an amazing time to be alive.
And it's not just about reading. You can literally get a world-class education from your couch without paying a dime in tuition. I'm talking about platforms like Coursera, where you can take actual college courses from schools like Yale and Stanford, or Khan Academy, or TED Talks. The only cost is your time and your curiosity.
Okay, so you've taken full advantage of all the free options out there. What's the next step on this thrifty journey? Well, now it's time to become a master at paying less for the things you do have to buy. I mean, just look at this. This is a perfect example. It's the exact same product, a Fitbit Charge 3, but the price ranges from $86 all the way up to $150. That's a huge difference. This is why a simple 30-second price comparison online before you buy anything is one of the easiest ways to keep your money in your pocket. And this quote, this is really the core of it all. Price is what you pay, value is what you get. Let that sink in. They are not the same thing. Your mission as a smart shopper is to find high-value, high-quality things when they're being sold at a low price. That is the sweet spot. That's true for buying stocks, and it's true for buying socks. And let's be crystal clear. Being thrifty does not mean you have to settle for low-quality junk. Not at all. It means getting the best stuff for less. Outlet stores are basically treasure troves. We're talking top brands, Nike, Gucci, you name it, selling their stuff for 25, 50, sometimes even 70% off retail. You just have to know where to look. All right, now let's talk about the small leaks that can sink a big ship. I'm talking about your daily expenses, that morning coffee, the lunch you grab, the gas you put in your car. These little choices might seem insignificant, but they compound over time and can make a massive difference in your financial future.
This is honestly my favorite Buffett story. The man literally decides which McDonald's breakfast to buy based on how the stock market is doing. If he's feeling good about the market, he'll splurge on the pricier biscuit. If not, he gets the cheaper sausage patties. Now, it's not about the 56 cents, it's about the discipline. It's a daily ritual that reinforces his core philosophy: every single penny matters.
Here's another one that's a total no-brainer: generic or private label brands. Look at this comparison. A 12-pack of Sam's Cola is almost half the price of Coca-Cola. A lot of times, these private label products are made in the exact same factories as the big brand names. So you really have to ask yourself, are you paying for the product inside, or are you paying for the fancy marketing in the red can?
So you might be thinking, okay, but saving $100 a year on gas, what's that really going to do? Well, I'm glad you asked. Thanks to the absolute magic of compound interest, that tiny $100 a year invested consistently can grow into over $100,000 over your lifetime. It's not about getting rich quick. It's about getting rich for sure. It's the eighth wonder of the world, and it's available to all of us.
Okay, now for some of the really fun stuff. Being thrifty isn't just about discipline, it can also be about being creative. It's about thinking outside the box, from old school trading to hunting for modern day deals.
This story sounds totally made up, but I promise you, it's 100% real. A teenager started with nothing more than a free cell phone. And through a series of 14 trades on Craigslist, he bartered his way up all the way to a Porsche Boxster. That is the art of the deal. It's about having the hustle and the vision to see value where other people don't. Incredible.
You just can't make this stuff up. Warren Buffett and Bill Gates, two of the wealthiest people to ever walk the earth, went to McDonald's for a meal, and Buffett whipped out coupons to pay for it. I mean, let that sink in for a second. If those guys aren't too proud or too rich to save a couple of bucks, then none of us are. It's a masterclass in staying grounded.
Okay, so we've got the mindset down, we've got a ton of tactics and strategies. Now it's time to put it all together. How do we turn all these thrifty habits into a concrete plan that will actually build your wealth over time?
But before we get to the numbers, just one last reality check from Buffett himself. It's so important to remember this. Money is a tool. It is not the goal. The real wealth in life, as he says, is your health, your relationships, your experiences. Being thrifty is what gives you the financial freedom to invest in those things that truly matter. And here it is. This is the absolute linchpin of this entire system: a budget. And please, don't think of a budget as a financial prison. It's not. It's a freedom plan. It's you telling your money where to go, instead of wondering where it went. And the golden rule, the most important part of any budget, is this: you have to pay yourself first. Before the rent, before the bills, before anything else, a portion of your income goes to your savings and investments. That's how you build wealth.
And there you have it, the Buffett blueprint for building wealth through thriftiness. But look, all this information is completely useless if you don't take action. So I'll leave you with this question. What is the very first thrifty step you're going to take? What's one small change you can make today? Right now, don't wait. Start small, start now, and just watch what happens.
All right, let's get into it. Today, we are going to break down two of the absolute biggest financial decisions pretty much all of us will face: buying a car and, of course, buying a home. And we're going to look at it all through the eyes of one of the greatest investors ever, Warren Buffett. And you'll see, his advice is way more down-to-earth and practical than you might think.
So let's start with this quote, because it's pretty wild when you think about it. This is a guy who built an empire, a multi-billion-dollar empire, by picking stocks. And yet he says his own modest home in Omaha, which, by the way, he bought way back in 1958 for about 30 grand, is in his top 3 best investments ever. That really makes you pause, doesn't it? For him, it's clearly more than just a place to live. It's a foundation for a good life and, yes, a solid investment. Okay, so you have to ask, right? If his home was number 3, what on earth could have possibly beat it for the top 2 spots? Was it some genius early investment in a company like Coca-Cola? Some stock pick that nobody else saw coming?
And here's the answer, and it tells you everything you need to know about his philosophy. It had nothing to do with money. His two best investments, he says, were marrying his two wives. And that right there shows us that what we're talking about today isn't just about spreadsheets and numbers. It's about making smart life choices that build real, long-term happiness and security.
So here's the game plan for our explainer. We've just touched on what Buffett really values. Next, we're going to get into the car conundrum. Then we'll tackle the big one, buying your first home. After that, we're going to decode the mortgage so it's not so intimidating. And finally, we'll wrap it all up with some key lessons in smart ownership. Sound good? Let's go.
All right, let's kick things off with that first major hurdle. For most of us, long before a house is even on the radar, there's the car. It's our first big-ticket purchase, a real taste of freedom. But man, it can also be a financial minefield if you're not paying attention. The choice you make here really can set the tone for your finances for years.
And the biggest trap, the biggest landmine of them all, is one simple word: depreciation. Just think of it like this. It's an invisible tax you pay for that new car smell. A brand new car can literally lose a fifth of its value in the time it takes you to drive it home. That is a massive, instant financial hit that a lot of people just don't see coming.
So this is the fundamental trade-off you're looking at. On the one hand, a new car is great. You get all the latest bells and whistles, that sweet, sweet manufacturer warranty, probably better gas mileage, but you're paying for it with that brutal depreciation. On the other hand, a used car has a much friendlier price tag because somebody else already took that biggest financial hit for you. The risk, of course, is you might have more repair bills down the road. A good middle ground can be a certified pre-owned car. You get a lower price, plus a warranty to give you some peace of mind.
This brings us to the next big question. And this quote from another famous tycoon, J. Paul Getty, just nails it. Cars are the textbook definition of a depreciating asset. They lose value over time. So, does that mean you should just always lease? Well, it's not quite that simple.
Now this is where it gets really interesting when you look at the actual cash flow. Check out the numbers for a pretty standard $25,000 SUV. The 3-year lease has the lowest monthly payment by a long shot, just $379. But here's the catch. After 3 years, you give the keys back and you have nothing to show for it. Now, if you buy it with a 5-year loan, your payment's higher, $495, but you're slowly building ownership. And with a 3-year loan, the payment's pretty steep, sure, but in 3 years, that car is all yours. So that low lease payment is tempting, but you have to ask yourself, am I paying for short-term convenience or am I investing in something I'll eventually own?
And before you get lured in by that low monthly payment on a lease, you have to read the fine print. Leases are really designed for people who don't drive a ton, usually around 12,000 miles a year or less. If you go over that limit, you're going to get hit with some nasty penalties, sometimes 15, even 25 cents for every single mile. And if you get a few dings or scratches beyond normal wear and tear, yep, that's coming out of your pocket too. Leasing is convenient for sure, but that convenience comes with some pretty strict rules.
Okay, let's shift gears and talk about the big one, the house. Homeownership. It's called the American dream for a reason. But as we've already seen with Buffett, you want to approach this with a very clear, practical mindset, not just emotion.
The very first decision is whether you should even buy in the first place. Renting, it has its perks. You have incredible flexibility, no need to save up a massive down payment, and hey, when the furnace goes out in the middle of winter, it's not your problem. But the downside is huge. Every single rent check you write is making your landlord richer. It's building their wealth, not yours. Buying is the complete opposite. It's a huge commitment, yeah. You need that down payment. You need a stable job. But every single mortgage payment you make is an investment in your own future.
So if you're seriously thinking about buying, Buffett's philosophy really boils down to checking these 3 boxes. First, you have to have a real down payment saved up. He thinks at least 10% is a good starting point. Second, you've got to be pretty sure you're going to stick around in that area for at least a few years. And third, and this is non-negotiable, you need a steady, reliable income. A mortgage is a long-term commitment, and the bank needs to know you can make good on that promise.
In this quote right here, this is the golden rule of home buying. It is so easy to get caught up in finding your quote-unquote dream home. But that dream can turn into a total nightmare if you're struggling to make the payments every month. The house you buy has to fit the reality of your paycheck. Period.
All right, now for the part that I think scares a lot of people. The mortgage. It sounds complex, it sounds intimidating, but I want you to start thinking about it less as a scary debt and more as probably the most powerful financial tool you'll ever get your hands on. Let's break down how it really works so it's not a mystery.
First thing you might run into is something called PMI, or private mortgage insurance.
Now, if you put down less than 20%, your lender is probably going to make you pay for this. And it's really important to know what it is and what it isn't. It does not protect you. It protects the bank in case you can't make your payments. So yeah, it's an extra cost every month, but here's the good news. Once you've paid down your loan enough to have 20% equity in your home, you can usually get that PMI removed.
Okay, next up is this big word, amortization. This is both the magic and, let's be honest, the frustrating part of a big loan. In the beginning, for the first several years, most of your monthly payment is just going to the bank as interest. Only a tiny little bit is actually paying down what you owe, the principal. It's only after years and years that your payments finally start making a real dent in the loan itself.
And this chart shows you exactly what I'm talking about. Look at the schedule for a typical 30-year loan. For the first, 10, 15 years, that giant blue area is all interest. See how little that green part, the principal, is? You're barely chipping away at what you actually owe. Then, as you get to the back half of the loan, it finally flips, and your payments start to really build that ownership, that equity. Understanding this visual is so important.
So how do you beat that curve? Well, one of the most powerful ways is just to shorten the loan. This bar chart here shows the total interest you'd pay on a $200,000 loan. With a 30-year mortgage, you end up paying almost $144,000 just in interest. But look at the 15-year mortgage. It's less than half of that. The difference is it's incredible.
Let's just put a number on it. In this one example, by going with the 15-year mortgage, you save over $77,000. That's life-changing money. But, and this is a big but, there's a trade-off. The 15-year loan comes with a much higher monthly payment. So you have to decide, do you want to pay way less interest in the long run, or do you need more cash flow and flexibility month to month right now? There's no single right answer. It's about what works for you.
Okay, we have covered a ton of ground here. Cars, homes, loans, all of it. So let's just take a step back and boil this all down into a few simple, powerful rules from the mind of Buffett that you can actually use. Here they are, plain and simple. First, remember that a home is more than a home. It's likely to be one of the best investments you'll make. Second, that J. Paul Getty rule. Buy things that go up in value, like a house, and think about renting or leasing things that go down in value, like a car. Third, and maybe most important, live within your means. The home has to fit your income. And finally, don't be scared of a mortgage. If you can afford it, it's actually a really smart kind of debt to have. And this last quote explains exactly why Buffett thinks that way. He calls a 30-year fixed-rate mortgage a one-way bet that's totally in your favor, the homeowner. And think about it, he's right. If interest rates go way up after you buy, who cares? You're locked in at your low rate, but if interest rates go down, you can just refinance and get an even better deal. It's a hedge you win, tails you don't lose situation. It's an incredible tool.
So, we'll leave you with this to think about. Now that you have these core ideas from one of the smartest financial minds out there, take a fresh look at your own life. Whether you're thinking about your next car or your first home, what is the single smartest move you can make right now to build a better financial future for yourself? The next step is yours. Thanks for tuning in.
When you think about Warren Buffett, your mind probably jumps straight to stocks, billions of dollars, the Oracle of Omaha. But what if I told you the single biggest key to his success, something he claims can boost your own lifetime earnings by 50%, has absolutely nothing to do with finance?
So let me ask you a question. This is a guy who went to Wharton and Columbia, some of the best business schools on the planet. Out of all his accolades, what do you think is the one and only diploma he actually hangs on his office wall?
You're looking at it. It's not the fancy Ivy League degree. It's a certificate from a Dale Carnegie public speaking course that cost him about $100. Why? Because he was so terrified of speaking to people, he knew it was holding him back. In his own words, that course changed his life. And that's what we're going to dig into today.
All right, so here's our game plan. First, we're going to explore just how deep this weakness of Buffett's really was. Then, we'll look at the specific Dale Carnegie tools that fixed it. After that, we'll see how he uses these skills to persuade people, how it all connects to what we now call emotional intelligence, and finally, how it all culminates in his ultimate strategy for success, choosing the right people to have around you.
So let's start with Buffett's greatest weakness. It's kind of hard to believe now, but the man we know as this witty, charming Oracle of Omaha, well, he started out as a self-described basket case when it came to dealing with people.
I mean, the change is just staggering, right? On the left, you've got this young kid who was so scared of public speaking, he would literally get physically ill just thinking about it. And on the right, you have the legend we know today, the guy who can stand in front of a stadium of 40,000 people with just a few notes in his head and totally command the room. How do you get from A to B?
And what's really interesting is he wasn't alone in this struggle, not by a long shot. Think about some of the most charismatic people out there. Ryan Reynolds, Johnny Depp, they've both said they're incredibly shy. Even a giant like Dr. Dre deals with social anxiety. David Bowie, he invented a whole new personality, Ziggy Stardust, just to cope with being on stage.
So here's the key. Buffett didn't just accept this weakness. He lived by this incredibly simple but powerful idea. If you know a skill is important and you know you're bad at it, you have to go out and fix it. He knew communication was going to be vital for his career, so he faced his fear head-on and made a conscious decision to improve.
Okay, so let's get into the actual toolkit that Buffett used. We're going straight to the source, Dale Carnegie's masterpiece, How to Win Friends and Influence People. This book was the foundation of the course that literally changed Buffett's life.
Carnegie's whole philosophy is, it's deceptively simple. Rule number 1, don't criticize, condemn, or complain. It just makes people defensive and they stop listening. Rule 2, give honest and sincere appreciation. Everybody is starved for it, and they'll go to the ends of the earth for someone who gives it to them. And number 3, frame what you want in terms of what they want. As we're about to see, Buffett became an absolute master of these first two.
And check this out. This is Buffett's own personal spin on Carnegie's rule. His method is brilliant. Praise people by name, directly, make it personal. But if you have to criticize the category. Investment bankers do this, or hedge funds do that. Never the person. That way you can make your point without making a personal enemy. It's so smart.
And here is that principle of appreciation in action. Maybe the most powerful example you'll ever see. Just think about what he's doing with this one sentence. He is telling the entire world that this one executive, Ajit Jain, is more valuable to the company than he is, or even his legendary partner Charlie Munger. That's not just a compliment. That's how you build absolute, ironclad loyalty for life. Now, these skills aren't just about being liked or getting people to do things for you. Buffett uses them to be unbelievably persuasive. Let's look at how he wins people over to his way of thinking, which is a whole other level of influence.
One of his secret weapons is this idea of inversion, which he picked up from Charlie Munger. A famous mathematician once said, "Invert, always invert." In plain English, it just means before you push your own argument, you first work really hard to understand the other person's point of view. See the world through their eyes. It's a game changer for finding common ground.
Here's another one that sounds so simple, but is almost unheard of in the world of big money and even bigger egos. Buffett is famous for admitting his mistakes. He does it quickly, he does it publicly, and he never, ever blames anyone else. This creates a level of trust that is literally a financial asset. Back in the 2008 crisis, companies like Goldman Sachs ran to him for help because they knew his word was gold. That reputation is priceless.
And if you want the ultimate example of this, look at the Dexter shoe deal. He used Berkshire stock to buy this company, and the company basically went to zero. The stock he traded away would be worth billions and billions today. A colossal mistake. And in his letter to shareholders, he didn't try to spin it. He just laid it all out and said plain as day, but they were mine. That's integrity. So we've seen these timeless rules from Dale Carnegie. But what's really amazing is that modern psychology has caught up and can now explain why they work so well. This brings us to the whole idea of emotional intelligence, or EQ. It's basically the science behind what Buffett figured out through practice decades ago.
So you can really think of two kinds of smarts. You've got IQ, that's your book smarts. It's your raw brain power, your ability to solve complex problems. Then you have EQ, your street smarts. That's your ability to understand and manage your own emotions and to read and influence the emotions of other people. Buffett's big argument is that while you need a decent amount of IQ, it's EQ that really separates the winners from the losers in life.
And this chart really visualizes one of Buffett's most surprising beliefs. He says, look, you need an IQ of maybe 130 to play the game at a high level. But once you're there, having an even higher IQ doesn't really help. In fact, he thinks it can hurt you. It can lead to overconfidence, to thinking you're the smartest guy in the room, which is exactly what happened to those Nobel Prize-winning geniuses at long-term capital management who nearly blew up the world economy.
And if you look at the modern framework for EQ, it's like a perfect roadmap of Buffett's life. Self-awareness, that's him realizing his fear of public speaking was a major roadblock. Self-management, that's his discipline to stay calm when everyone else is panicking. Social awareness, that's the inversion principle, seeing things from the other side. And relationship management? That's pure Dale Carnegie, praising people, building trust. It all fits together perfectly. And this brings us to our last stop, and honestly, it might be the most important lesson of all. All these skills, communication, empathy, self-control, they all point to one of Buffett's core life philosophies, the profound importance of who you choose to spend your time with. For him, this is the ultimate investment.
You've probably heard this quote from Jim Rohn before, and it's famous for a reason. It's true. The people you surround yourself with, your friends, your colleagues, your partner, they have this invisible but massive influence on your attitude, your ambition, and your habits.
And here's the Buffett version, and it's not passive, it's an active strategy. He says you should deliberately seek out people who are better than you in some way, people you admire. Why? Because behavior is contagious. If you hang around people with great habits, you'll naturally start to drift in that direction.
And that philosophy leads to these two non-negotiable rules for his life and business. First, only work with people you actually like, trust, and admire. Life's just too short for anything else. And second, something he learned the hard way, it is almost impossible to make a good deal with a bad person. Character always trumps the terms of the deal. Always.
You know, Buffett loves this quote, "The chains of habit are too light to be felt until they are too heavy to be broken." And that really sums this all up, doesn't it? The little things you do every day, the way you talk to people, who you choose to eat lunch with, whether you criticize or appreciate, they don't seem like a big deal at the moment. But over time, they forge the chains that become your life. So the question to leave you with is this: what habits and what chains are you forging today?
All right, let's talk about some of the biggest decisions you're ever going to face. I'm talking about college, choosing a career. It can feel, well, pretty overwhelming, right? So today we're going to get some guidance from one of the most successful investors of all time, Warren Buffett. We're going to open up his playbook and see how his principles can help us with our own biggest investments.
You know, Buffett really doesn't beat around the bush. He boils life's big questions down to two critical choices. Now, he's got plenty of wisdom on both, but for this explainer, we're going to zero in on that first huge decision, your career and the whole educational journey that gets you there.
And right here, this is the bedrock idea for everything else we're going to talk about. This isn't just about shelling out money for school. It's about making the single most important investment of your life, an investment in you, in your own potential. Because at the end of the day, you are your own greatest asset.
So, what does investing in yourself actually mean? It sounds simple, but as you're about to see, it has some really profound implications for pretty much every single educational and career choice you're ever going to make.
Buffett has this incredible knack for boiling complex things down to their very essence, and this is one of his core beliefs. The more you learn, the more you earn. Simple as that. It's a direct connection he has seen play out for decades. Just think of it like the ultimate form of compound interest, not for your bank account, but for your brain. And of course, your future earning power. Now, investing in yourself doesn't automatically mean you have to go to a 4-year university. Not at all. In fact, Buffett himself was a little hesitant to go to college at first. He totally gets that there are many paths to success, and the right one, well, that depends entirely on you, what you're passionate about, and what he would call your circle of competence.
So let's actually compare the three main avenues you can take. You've got your traditional 4-year college. It's the classic campus experience, but it also comes with the heftiest price tag. Then there's community college, which is a really financially savvy way to start. You can get an associate's degree, or you can bank credits and transfer later. And hey, do not overlook trade school. It is a direct, hyper-focused route to mastering a valuable, hands-on skill, and you can often do it in half the time. Each one is a different kind of launchpad. The key is figuring out which one best aligns with the career you're really excited about.
So, if you are heading down that college path, the application process itself can feel like a monster of a task. But let's break down the strategy, okay? Your grades and test scores, those are your base stats. They're what gets you in the game. But your essays and your extracurriculars, that's your story. That's where you show them who you really are. And honestly, that's often the deciding factor. Oh, and here's a little pro tip. For your absolute dream school, that early decision option can be a real game changer. It can sometimes even triple your odds of getting in.
Okay, so you've picked a path. Now comes the next massive hurdle, figuring out how to actually pay for it. This is where that whole idea of an investment gets very, very real. So let's not be shy about the numbers.
Yep, you're seeing that number correctly. For a lot of private universities, the all-in cost, and I'm talking tuition, room, board, the whole shebang, can skyrocket past $300,000. A number like that just forces you to be strategic.
It makes having a solid financial plan completely non-negotiable.
But here's the critical thing to remember. Almost nobody actually pays that full sticker price. The cost is almost always covered by a mix of different sources, and this chart breaks it down perfectly. You've got what the family can contribute, sure, but you also have student loans, work-study programs, government grants, and scholarships. That's the free money. For any family, the big strategic goal here is to make those free money slices of the pie as big as you possibly can.
Now, one of the absolute best tools for that family contribution slice is something called a 529 plan. The easiest way to think of it is like a retirement account, but for education. You put money in, it gets invested, and the earnings grow completely tax-free as long as you use it for qualified expenses like tuition, books, even housing. It's a really powerful way to save up.
Now, even with all the planning and saving in the world, student loans are just a reality for most students. The average graduate today walks into their career with nearly $40,000 of debt. And that's a number that can absolutely dictate where you live, what job you can take, when you can afford a house. It's exactly why understanding how to borrow responsibly isn't just a good idea, it is an essential life skill.
The investment in yourself doesn't always stop with a bachelor's degree. For some people, the next strategic move is graduate school. It's actually a path Buffett himself took. He earned a master's in economics from Columbia. And that wasn't just a whim. It was a calculated investment so he could study under his mentor, Benjamin Graham. And that one decision profoundly shaped his entire life as an investor.
So, when does a move like this make sense for you? Well, sometimes it's mandatory, right? If you want to be a doctor or a lawyer, you don't really have a choice. But for most of us, it should be a very strategic calculation. Is your career hitting a ceiling? Do you need to pivot into a totally new field? Or do you see a clear opportunity where an advanced degree would be like rocket fuel? You have to think of it as a significant investment that should come with an expected return.
All right, the investment has been made. You've put in the time, you've put in the money. Now we shift our focus to the return, landing that first great job. And the key that unlocks that whole process? Well, it's a single, powerful piece of paper.
The very first step is to completely change how you think about a resume. It is not a history of your past. It is a one-page ad, and it's designed to sell the most important product there is, you. It has to be concise, it has to be compelling, and it has to make an employer immediately say, I want to talk to this person. For a student or a recent grad, that means one page, period, no exceptions.
So to make this really concrete, we're going to use this example from a fictional student we'll call Pat Jones. Now, I know there's a lot on this page, but don't worry about it. We're going to zoom in and break down exactly what makes this a truly world-class resume, piece by piece.
Let's kick things off with work experience. This is where you have to communicate your value in a way that Buffett would appreciate. See, Pat doesn't just say, I worked at a coffee shop. Pat quantifies the impact. Improved profitability by 10%. Trained 5 new employees. Look, numbers are the language of business. They prove your value and they make your contributions tangible and, frankly, impossible to ignore.
Okay, next up, check out the skills section. What's so effective here is the blend. Pat doesn't just list the hard technical skills like Python or financial modeling, they also highlight communication skills, like being fluent in multiple languages. This combination paints a picture of a really well-rounded, versatile candidate, not just a number cruncher.
And the immediate goal of a killer resume like Pat's is often to land an internship. Why is that so incredibly important? Because of this number. 3 out of every 4 interns get a full-time job offer. An internship is not just a summer job. It is the single most effective tryout you can have for a full-time career.
So, we've spent all this time crafting this key asset, your resume, but Buffett will be the first person to tell you that the most valuable asset you will ever own isn't a document at all. It's something you build every single day, and it's so much more important and so much more fragile.
To really understand what Buffett values most, you have to hear this story he tells. It's about a woman named Bella Aidenberg, a Holocaust survivor. After she had witnessed the absolute worst of humanity, she developed a simple test for friendship. She would look at someone and she would ask herself one single question: would you hide me? I mean, that is just such a profound and chilling measure of a person's character. It gets to the very heart of the trust you inspire in other people.
And that brings us to Buffett's ultimate lesson. Your reputation is your true net worth. He says it takes 20 years to build and 5 minutes to ruin. If you just let that one idea sink in, really think about it, it will change how you approach every single decision you make, big or small. So, we're going to end with this question. We've spent this time talking about how to build a resume to get your foot in the door, but how are you going to build the reputation that defines your entire career? That's the real investment, and it's an investment that starts today.
So, what if you could get career advice from, well, one of the most successful people on the planet? Today, we're going to do just that. We're unpacking a playbook for your professional life, and it's all inspired by the timeless wisdom of Warren Buffett. Whether you're just starting out or you're already climbing that ladder, these are the kinds of principles that help you build not just a successful career, but one you actually love. Okay, let's just start with this one powerful idea from Buffett. It really cuts right to the heart of everything. He says, take the job you would take if you were independently wealthy. Think about that for a second. This isn't about the money. It's about figuring out what you're so passionate about that you do it for free. That's the mindset we're going to use as our guide today. You know, in today's world, your journey to that dream job, it doesn't start with a resume or an interview. Nope, it starts online. So let's talk about how to build a digital presence that tells your story the right way and really builds a solid foundation for you. Check out this number. Over 500 million. That's how many people are on LinkedIn. And look, this is not just another social media site. It's the world's biggest professional network. It's your living, breathing resume. It's your main networking tool. And for a lot of recruiters, it is the very first place they're going to look you up. If you're not on there, you're practically invisible. And now for a little dose of reality. You have to assume that potential employers are going to Google you. They're going to look past your perfect LinkedIn profile to your other social media. And here's the kicker. What they find can stick around forever, even if you delete it. It's so important to treat every single thing you post as part of your professional brand because, well, that's exactly what it is now. What's amazing is that Buffett nailed this idea decades ago, long before anyone had ever heard of social media. He called it the front page test. And yeah, he was talking about business ethics, but it's the perfect rule for your online life. Before you post something, just ask yourself, would I be okay with this being on the front page of the newspaper for my parents, my friends, my future boss to see? If the answer is no, it's simple. Don't post it. Okay, so you've cleaned up your digital act, you've got a strong presence, now you're ready for the next phase. This is where we turn that great online impression into an actual job offer. We're moving from the screen into the real world. Listen, if you get an interview, it means you're already qualified on paper. The interview is where you prove it, and preparation is what's going to make you stand out. You've got to do your homework. Seriously, dig into the company's history, know who the key players are, understand their finances and who they're up against. And of course, practice those common questions, not to sound like a robot, but so you're confident and clear. And always remember this, an interview goes both ways. You are interviewing them just as much as they're interviewing you. Buffett lived this. He chased a job with his mentor, Benjamin Graham, because he knew working with people you admire is priceless. So as you're in there, ask yourself, do I actually like these people? Does this place inspire me? Ah, yes, the classic, what's your greatest weakness question? Look, every interviewer has heard I'm a perfectionist a million times. They see right through it. They're not looking for a fake strength. They're testing your self-awareness. The best way to answer is to be honest about a real area you're working on, and then, this is the important part, immediately explain what you're actively doing to get better at it. That shows maturity. Okay, every now and then, you're going to get thrown a curveball like this. First thing to do, just breathe. Don't panic. The interviewer does not actually care how many golf balls fit in a 747. That's not the point at all. What they really want to see is how you think. They want to see your problem-solving skills in action. So just talk them through your logic. Break the problem down. Okay, first I'd estimate the volume of the plane. Then I'd estimate the volume of a golf ball. State your assumptions out loud. Showing a clear thought process is way, way more impressive than pulling a random number out of thin air. So you did it. You got the job. Congratulations. But here's the thing. Getting the offer isn't the finish line. It's the starting line. The real work, the work of building a great career, that starts right now. You know, just being talented isn't going to cut it. Real long-term success is built on something called grit. It's this amazing mix of being passionate about what you do and having the perseverance to stick with it, especially when things get hard. It's about being resilient, learning when you fail, and just keeping going. When Buffett looks at people, he boils it down to these three things. And the order here is everything. He famously said that if you don't have the first one, integrity, the other two, intelligence and energy, will kill you. Think about that.
But the good news is these are things you can bring to work every single day, no matter what your job title is. Be honest, be smart, and bring some passion.
Your formal education doesn't end when you get a diploma. The most successful people never stop learning. I mean, Buffett himself is famous for reading for hours and hours every day. Now, you don't have to do that, but the principle is key. Commit to always learning. Read books, listen to podcasts, and maybe most importantly, learn from the experienced people around you. Stay curious.
All right, a successful career usually brings some financial rewards. But just earning a good paycheck is only half the equation. The other, and I'd argue more important half, is knowing what to do with that money, how to manage it, save it, and make it grow. This is one of the most important skills you'll ever learn. Let's quickly break down the two big types of retirement plans you'll probably see. First, you've got the old school pension, or a defined benefit plan. They're getting rarer, but they promise you a set monthly check for life from your company. Much more common now is something like a 401k, a defined contribution plan. The key difference? It's an investment account that you own, which means you can take it with you if you ever leave that job. Now, inside those plans, you usually get a choice, traditional or Roth. And it all boils down to one simple question. When do you want your tax break? With a traditional account, you put money in before taxes, which lowers your taxable income today. But you'll pay taxes when you take it out in retirement. A Roth is the exact opposite. You put in money you already paid taxes on, but, and this is huge, all of your growth and all your withdrawals in retirement are 100% tax-free. And this is where you really see the magic. It's the power of compound growth. It might not feel like you're doing much, but saving just $250 a month starting at age 25 can turn into over $1 million by retirement. This just proves it. The most important ingredient for successful investing isn't a huge pile of cash, it's time. Time is your greatest asset. Okay, so let's tie all of this together. Your career choices, your finances, your constant learning. We're going to wrap it all up with one last really powerful mental model from Warren Buffett that can help you with basically every big decision you make in life. He calls it his 20-slot punch card rule. Imagine you get a punch card at the beginning of your life, and it only has 20 holes in it. And every time you make a big investment, you have to punch a hole. If you only had 20 big decisions for your entire life, you'd think really, really carefully before each one, right? You'd wait for the truly great opportunities. And this isn't just about investing. This is a framework for life. It forces you to focus on what really matters. So as you think about your next career move, your next major purchase, whatever it is, just ask yourself that question. Is this really worthy of one of my 20 punches? That kind of thinking, that's how you build not just a great career, but a truly great life.
You hear the name Warren Buffett, and what comes to mind? Investing, right? Berkshire, Hathaway, Omaha, just staggering amounts of wealth. But what about the philosophy behind that fortune? Well, today we're diving into Buffett's other playbook. Not just how to make money, but how to give it away, the ethics of success, and maybe most importantly, what it truly means to live a rich life.
So let's just start with a number that's, well, it's pretty much impossible to wrap your head around. $80 billion. That's roughly the amount Warren Buffett has pledged to give away. Now, to put that into perspective, that's over 99% of his entire net worth. We're talking about a commitment on a scale that is almost unparalleled in all of human history. Just incredible.
And that, of course, brings up a really fundamental question. If you build one of the world's greatest fortunes, and then you decide you're going to give almost all of it away, what do you value most? What becomes your ultimate return on investment? Well, let's find out.
To really understand Buffett's philosophy, we first have to get a handle on the sheer magnitude of his pledge. I mean, this isn't just some casual donation. This is a core part of his life's work.
You know, it's important to understand that Buffett's approach is what we call philanthropy. Charity is great. It often addresses immediate needs, like after a natural disaster. But philanthropy, the way he sees it, is about going after the root causes of problems. It's a long-term strategic game aimed at creating solutions that last.
And his approach goes way beyond just writing a check. He actually co-created a whole movement. The Giving Pledge, which he started with Bill and Melinda Gates, has encouraged hundreds of the world's wealthiest people to commit at least half their fortunes. And his reason for giving most of his own money to the Gates Foundation? It's pure Buffett pragmatism. He figures they've already built the best, most effective machine to get the job done right.
Okay, so we've seen the scale of his giving, the what. But honestly, the more interesting question is the why. What are the fundamental beliefs that drive this incredible level of generosity?
This ancient proverb, it just gets right to the heart of it. For Buffett, giving isn't just some duty he has to perform, it's a source of real, deep personal fulfillment. It's not a transaction where one person loses and the other one gains. No, it's a true win-win. It adds a whole other dimension to life that's just more thoughtful, more fulfilling.
He applies his core business ethics directly to his personal philosophy. It's basically a financial spin on the golden rule. And it's such a simple but incredibly powerful idea. Treat other people's resources with the exact same care and consideration you would give your own. That, right there, is the bedrock of trust.
And he really truly lives by this. This is not just some nice saying he hangs on a wall. At NetJets, a company Berkshire owns, Buffett is a customer just like anybody else. He pays the same rates, he gets the same service. As he puts it, we eat our own cooking. And that just shows you this principle isn't only about money. It's about integrity and fairness in everything he does.
Now that we get the why, let's dig into the practical how. See, for Buffett, just having good intentions is nowhere near enough. Giving, just like investing, has to be effective to actually be meaningful.
Okay, check this out. This is a perfect example of his impact. For years, Buffett auctioned off a lunch to benefit the Glide Foundation, a fantastic charity helping the homeless in San Francisco. And look at these numbers. The bids went from just $25 grand in 2000 to over $4.5 million by 2019. And the best part? The irony is that the record bid came from a crypto entrepreneur, which must have made for a very interesting meal, considering Buffett famously called Bitcoin rat poison squared.
This is a classic Buffettism, and it applies to literally everything he does, from business to philanthropy. He believes that feeling good about what you're doing is totally irrelevant if you're not actually getting anything done. You have to measure your impact. Noble intentions are just the starting point. They are absolutely not the finish line.
And here's exactly how you do it. He has this fantastic line about some managers who shoot the arrow of managerial performance and then hastily paint the bullseye around the spot where it lands. He argues you have to do the complete opposite. You define what success looks like before you even start. You set clear, objective goals so you can honestly look back and know whether you've actually hit the mark. So let's zoom out a little bit. This whole philosophy of responsibility, it goes way beyond just personal giving. It extends into the very fabric of the economic system that made him so wealthy in the first place.
To get his view, you really need to understand this concept called creative destruction. Just think about how we listen to music. First, there were records. Then they were replaced by 8-tracks, which got replaced by cassettes, then CDs, and now streaming. Each new technology created new industries and amazing opportunities, but it also destroyed the old ones. This process drives progress for all of society, but it definitely comes at a cost.
And this is that cost. Buffett, who calls himself a card-carrying capitalist, is just brutally honest about it. He uses this powerful, if kind of stark, metaphor of roadkill to describe people whose jobs and livelihoods just get wiped out by this relentless march of progress. He argues that a rich, decent society has a moral obligation to create safety nets for those who, through no fault of their own, get left behind. So, if you're going to operate within this system, what is the single most important asset you have? It's not money, it's reputation. This is one of his most famous quotes, and it's really the core of his operating manual. Money can be lost and made again, but reputation, once you tarnish that, it's incredibly difficult, sometimes impossible to get back.
And he has absolutely proven he means it. In 1991, when the investment bank Salomon Brothers was on the brink of collapse from a scandal, he stepped in personally to save his reputation, even testifying before Congress himself. Fast forward 20 years, and when a top executive, David Sokol, did something ethically questionable, Buffett called his actions inexcusable and accepted his resignation. The message could not be clearer. You protect the reputation at all costs.
Okay, so finally, let's look at the most personal aspect of his philosophy, how Buffett sees his own legacy, and what he believes is the ultimate measure of a life well lived. Let's start with what he plans to leave his own children. He has thought about this so deeply. The big risk of a massive inheritance is that it just saps motivation, creating what he calls couch potatoes. So the goal isn't to give them so much money that they can do nothing, but just enough so they feel they can do anything. It's a very, very fine line to walk. This single line sums up his entire philosophy perfectly. He's not talking about setting them up for a life of leisure. He's talking about giving them a head start.
Enough to pursue their passions, start a business, whatever they want. It's all about enabling productivity and merit, not entitlement. This idea is absolutely crucial to understanding his whole worldview. Buffett attributes his incredible success to a bunch of things he had zero control over. Being born in America, having what he calls lucky genes, and the simple magic of compound interest. He calls this winning the ovarian lottery. And this deep-seated belief that so much of his success is just due to pure luck is the main reason he feels such a powerful desire to give back to the society that made it all possible.
So after a lifetime of accumulating wealth, analyzing businesses, and navigating markets, this is it. This is Buffett's ultimate definition of success. It has absolutely nothing to do with the numbers in a bank account. It's about love. And coming from one of the richest people who has ever lived, man, that statement just carries an immense amount of weight. The ultimate currency isn't the dollar. It's the affection of the people you care about.
And really, that's the perfect place to end. Buffett has shared his metric, one he's honed over a 90-year life of incredible achievement. And it kind of forces us to ask ourselves the same question. Beyond our careers, beyond our finances, beyond our ambitions, what's our ultimate bullseye? How are we going to measure our own success?